We've got this extraordinary stock market.
The U.S. capital market is the most liquid of the world.
This has been an earnings-driven market.
We've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
I don't think we're in a bubble. And if we are, it's so early stage.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, spooked by credit. Equity markets heading towards a second straight day of losses as two regional lenders are fueling fears about a turn in credit, driving investors into bonds, taking yields down to new lows for 2025. A touch of drama heading into the weekend.
There's a lot more concern now what's going on in the credit market, or it's concerns, it's cracks, or as Jamie Dimon said earlier this week, Jonathan, it could be cockroaches. Are we seeing more of these? Now, normally we wouldn't talk about these smaller regional players during especially big banks' earnings week, but the fact of the matter is they were victims, saying they're victims of fraud on loans to funds that invest in distressed commercial mortgages. And there's concern now that potentially, as Jamie Dimon said, when there's one, is there going to be more?
As you often hear from credit investors over the years, the worst of loans are made in the best of times. That's why people are nervous. We've had the best of times for quite a while. This just came from David George of Baird, an analyst on some of these names, taking advantage of today's weakness in the bank group and upgrading Zion to outperform. Why? He says market participants are fighting the last crisis. A $1 billion cap decline over a $50 million loss seems a bit excessive. People are spooked because of the events over the last month.
And at the same time, you do have stock market at an all-time record. We continuously are trading around this record high. So is this an excuse, a moment to potentially take money off the table? Because you are concerned. There is a wall of worry. We have been discussing for weeks what is going on in the world in the macro environment. The credit market could be the reason why individuals are saying maybe it's time to hit pause.
If you are just joining us, welcome to the program. Equity futures down by more than 1% on the S&P 500. That bid into bonds has been pretty consistent over the last week. It's a drop below 4 on 10s, sub 4% on a 10-year government bond yield, and new lows for 2025. Coming up this hour, we'll catch up with Matt Miskin of John Hancock as equities are tumbling on new credit concerns. Ian Harnett of Absolute Strategy Research seeing signs of an AI bubble. And Chris McGrassie of KBW as two regional banks shake investor confidence. We begin this hour with stocks sliding and the 10-year bond yield falling below 4% as more credit cockroaches are seemingly uncovered. Matt Miskin of John Hancock writing bond yields are living on the brink. If yields fall, income opportunities that we've been talking about for years will vanish. Matt joins us now for more. Matt, welcome to the program, buddy. Before we get into the bond market, let's talk about what sparked the recent move in the last 24 hours, credit jitters. Matt, how justified are those concerns this morning?
We're going to just have to see. I'm looking at high yield spreads, John, this morning. I'm not seeing that much credit concerns. High yield spreads are still under 3% here. So broadly speaking, the markets are holding up okay. But it's almost like you're a mechanic here and you're opening up the hood and you got to see what's underneath it. And it's hard to do because it's not that transparent. In general, though, as you two have just brought out in terms of opening up the show, markets were priced for perfection. You know, we're still at 22.5 PE on the S&P 500 near all-time highs. High yield spreads are still tight. We just had a massive rally. In our view, you wanted to manage risk. You wanted to prune some of the winners. Income is still available, but it is moving away fast. We want to make sure we've got that in the portfolio and move up in quality.
So let's just stay on the credit story, Matt, just for a few more beats. There's obviously concern about the credit cycle turning. But when you look at non-performing loans, net charge-offs of the banks, there doesn't appear to be much to worry about. In fact, the banks, the big players at least so far this week, have absolutely crushed estimates. But Matt, you've got these big flashy headlines, Tricolor, First Brands. Is there anything more than that catches your eye?
Yeah, more broadly, the macro has been weakening for months. And, you know, we've been talking about this. You know, the jobs data is getting weaker. We've had housing slumping. We've had, some of the business surveys have been weaker, and it's all over the place. So in our view, the macro has been signaling to you that the underlying economy has been weakening, and yet asset prices haven't reflect that at all. So what we're looking at is more of a realization that the underlying economy isn't as strong as the markets had been reflecting. In our view, that's a dose of reality that's probably good. You know, I think about Got Milk. Well, it's got bonds right now, high quality ones in nature. In our view, they've been underappreciated for much of this year. Pound for pound, they're up about 7-8% with much lower volatility than equities. not a bad place to be right now.
So, Matt, when you say bonds, what are you actually talking about specifically? You're talking about treasuries or something else?
Yeah, treasuries are a part of that. MBS, investment grade corporates. Investment grade corporates is our new high yields in terms of how much credit risk we're willing to look at, but also municipal bonds. This is a kind of a sleepy part of the market for U.S. investors, but tax-free municipal bonds are actually on a tax equivalent basis giving you almost high yield type income. To us, that's a really attractive place to be too.
Matt, does this remind you a little bit of what happened in 2023 when it comes to Silicon Valley Bank?
It's a start. Yeah, the shoot first, ask later type market response is definitely reminiscent. It's bringing back flashbacks of that period. The difference between now and then, the Fed was hiking back then. The 2-year yield sniffed it out just like it's sniffing it out now, but the 10-year yield back then was about 3.4%. So just to put it in perspective, that's how much more we could see a drop in the 10-year just pricing this in. Now then, the Fed also stepped in. So we've got a Fed that's all over the place. Just yesterday, the last 24 hours, it's even more bifurcated on Fed messaging. You had Waller saying one thing, Moran saying another. And so you've got to get the Fed to start signaling that they would be a backstop, in my view, to start to heal this kind of regional bank stress. But with a Fed that's really diverging in outlook, it's going to be hard to get them all on the same page.
Well, they're not diverging in terms of what they expect at the end of the month, which is a rate cut.
Yeah, after that, though, what's next? Waller's saying basically yesterday, we might need to take a break after that. Moran saying we should do 50 basis points. So, obviously there's different perspectives there, but it's what next? And the signals, if the 2-year yield is telling you, the 2-year yield just broke 3.5%. And I just keep going back to, if you want to have a Fed view, talk to the 2-year. The 2-year yield is the best crystal ball on Fed policy. And it just told you that the Fed's going to have to act more aggressively on cutting than it did before this week.
339 at the moment, which is quite a rally considering where we were only a few months ago discussing what the Fed could or couldn't do. We're down 3 basis points on a session so far. Matt, this move more recently, though, is about credit and risk aversion, driving people away from equities into bonds. When you look at the broader economy, and this is a conversation we had with Governor Waller yesterday, the broader economy seems to be okay. The one standout, in fact, some people might say the outlier, is this massive step down in payrolls. And Governor Waller himself will acknowledge it's kind of strange that you've seen this massive step down in payrolls, employment, and at the same time retail sales has held up. Matt, how do you think that's going to resolve itself in the coming quarter?
Yeah, I mean, Halloween's coming up here, and I think about basically the Fed has an eye patch on right now. They're going to get part of their mandate data with the CPI just because they want to open it up for the COLA reassessment, but they're not getting much jobs data. The NFP is not going to be there because of the government shutdown. So they're almost half, they've only got one eye really to look at this. I'm looking at Indeed job opening data. It's on the Fred website if you ever want to nerd out and watch some economic charts with me. That keeps going down. This website, this other source called Link Up provides data on job openings. That actually just showed September job openings were moved down. Basically, companies are starting to move job openings off. And to me, that's just showing more weakness in the jobs data. I think the Fed is underappreciating this. You go back over history, negative NFPs or jobs reports are very infrequent. Most of them happen in recessions. The only time that we saw it not in a recession was 1996. So either you need the markets to keep going like this. And just to put this in perspective, John, consumer net worth is $170 trillion. All right. The economy is 30 trillion. Basically, the markets and the wealth effect of the markets is overpowering the economy. That's what matters. And if you get jitters in these markets that show a negative wealth effect translate into the economy, I think that's going to spell more weakness on top of the already weak jobs data. And to us, that means the Fed's going to have to cut more than they expect.
So what does that mean, Matt? So right now, Fed funds has a 4 handle. What do you think it's going to look like 12 months from now?
I think it could be sub 3%. And if you're down to 3, and this is a global phenomenon, look at the European 2-year yield. It just rolled over after being in a nice uptrend. In the end of all this, excuse me, But basically, we could go all the way almost back to zero interest rate policy. We haven't even gotten to the hard part yet.
Hold up, Matt. Pause. You think we can go back to zero?
We haven't even gotten to a recession yet or any real liquidity event. High yield spreads are still tight. The market's near all-time highs. This is not yet the real troubling part of the market. When we get there, I think the Fed's going to have to cut more than the markets think. I think it's going to be a global phenomenon. And I think you could need to go back there. The government doesn't have the ability to provide fiscal stimulus like last cycles because they are so tapped out. They've already done so much. So the government's going to say, look, we can't provide the stimulus we used to. Federal Reserve, it's on you to get us out of this. And I think that's going to make them have to cut more than they typically have to and maybe even reach the lower bound.
Matt, appreciate it, sir. Matt Miskin of John Hancock. Everyone's entitled to an opinion. If he's right, Governor Myron has got some company.
Governor Myron might have some company, and potentially Governor Myron could do that at the end of the month when he sits down with his colleagues and explain his point of view. But I don't think Waller was saying they can't go there. The quote from Waller is, you don't want to make a mistake. You want to be cautious and you want to be careful. So why not do 25 and then recalibrate and see where the economy is? And also, maybe we'll get some government data.
This market recalibrating, bond yields down on a 10-year maturity now. About 396 at the front end of the curve. Two's down 339. Let's get you an update on news worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Good morning, John. Yes, back to those regionals. The S&P Regional Banks Index suffering its worst day since April after Zions Bancorp and Western Alliance said they were victims of suspected fraud on loans tied to distressed property funds. 74 of the biggest U.S. banks shed more than $100 billion in market value. The White House is poised to deliver a major win for automakers, easing tariffs after months of lobbying by Ford and GM. The Commerce Department is expected to announce a 5-year extension of an agreement that allows car makers to reduce duties on imported parts. It's a key offset to Trump's record-level auto tariffs. President Donald Trump's former national security advisor, John Bolton, has been indicted over allegedly mishandling classified documents. Bolton was charged with 18 counts by a federal grand jury in Maryland. He served for more than a year in Donald Trump's first administration, but then became an outspoken critic of the president. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, bringing Russia to the table.
I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. We hope we're going to get it stopped.
That conversation up next with the former White House Deputy National Security Advisor, Victoria Coates, from New York City this morning. Good morning. Two names in a moment in the pre-market shaping up as follows. Zions down 1%. Western Alliance down by 1.5%. These so-called one-off credit events are starting to add up. These two banks disclosing a $50 million charge-off. That was Zions yesterday. Western Alliance also revealing some negative exposure to potential fraud. This is a conversation that builds after the events of the last few weeks, including Tricolor and First Brands. And it's dragging down the big players as well. Check this out in the pre-market. The likes of JP Morgan down by 1.5% also. This after a week of fantastic earnings from all the banks on Wall Street. Beats across the board. Citi's down by 2% on the session. That risk aversion reflected in the broader index as well. On the S&P 500 down here by 1%. On the Nasdaq 100 down by 1.3%. Also captured in the bond market. 10s sub 4%. 2s sub 340. We're down 4 basis points at the front end. 338. One guest already. It's just amazing how quickly the tide turns. One guest already on this program talking up the potential of taking rates down to zero. Steady on. That's a major call from John Hancock a little bit earlier this morning. Check that interview out with Matt Miskin on Bloomberg.com and on the Bloomberg terminal. Under surveillance this morning, let's talk about foreign policy, bringing Russia to the table.
I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. Tomorrow I'm meeting with President Zelensky, and I'll be telling him about the call. I mean, we have a problem. They don't get along too well, those two. We hope we're going to get it stopped.
So here's the latest this morning. President Donald Trump meeting with the Ukrainian leader later on today and planning to meet with the Russian leader in the coming weeks. For an update, Bloomberg's Jack Fitzpatrick joins us now for more. Jack, we had a feeling after the big event in the Middle East earlier this week that this would be the next big effort. How are things shaping up?
Yeah, there's a lot of expectation among both sides, or all sides, I should say, that the developments in the Middle East have enabled the Trump administration to shift its focus to potentially take a different direction on the Russia-Ukraine war. Both Russia and Ukraine were hoping that could play to their advantage. We're still finding out whether this latest development, setting another meeting with Putin, is a reversal to President Trump's original position, trying to seek a friendly relation with Putin and call off the pressure campaign against him. I think we'll learn a lot more because there is the meeting today, this afternoon, in the White House with President Zelensky, who likely has learned some lessons from his last Oval Office meeting. You can't pressure Trump too much to come to your aid, but Zelensky, I'm sure, will try to suss out exactly what Trump's position, exactly how much he's changing. Lately, he's been much more favorable to Zelensky and more pressure, focused on pressuring Putin, but we'll see how much of a reversal that is, and we've got a couple weeks of planning for this Budapest meeting to figure out exactly what Trump's position is.
Jack, given the apparent success of the president in the Middle East, is there a sense that the president's now operating from a position of increased strength?
Yes, that seems to at least be his interpretation and the expectation of President Trump, that he's gotten one thing more or less off his plate and can focus on Russia and Ukraine if that's where he wants to put his focus. The president is someone who operates on a sense of what victories have I had, operating from a position of strength, getting momentum off of what he sees as a win. He's feeling good about what he's done in the Middle East. And I think, again, that raises questions about what direction he takes this with regard to Russia and Ukraine. But he's looking to make decisive moves on that front.
Hey, Jack, appreciate the update. Thank you, sir. Jack Fitzpatrick of Bloomberg down in Washington, D.C. To extend the conversation, the former Trump Deputy National Security Advisor Victoria Coates joins us now for more. Victoria, welcome to the programme. We have an anti-war president who's not afraid of using hard power to try and de-escalate things. That's put him in a position of strength in a place like the Middle East. Can we leverage that success in that region and apply it to this war in Ukraine?
Well, good morning. Yes, I think we can. And certainly what was demonstrated by President Trump last week, bringing together all of those heads of state, not just from the Middle East, but from Europe, from countries like Pakistan, from Indonesia, together to get to progress on the Middle East. And we saw the hostages come out of Gaza. Nobody thought that was possible. And I don't see anyone, not Vladimir Putin, not Chairman Xi of China, performing that way on the world stage in terms of diplomacy, in terms of progress towards peace. So I think that does build momentum for him. Obviously, the Ukraine problem set has been intractable. He has said repeatedly he thought that was going to be easy. It's turned out to be the hardest. But progress in this phone call with President Putin, in the decision to meet in Budapest in coming weeks, hopefully we can get towards a resolution.
How does the president cajole Putin to the table? What carrots could the U.S. offer?
Well, I don't know that it's so much carrots. What I heard also in his remarks yesterday, which caught my attention, is the assertion that India is going to start to reduce their purchases of Russian oil. India is now the second largest purchaser of Russian oil. And in the first Trump term, the Indian purchases of Russian oil were very small, maybe 5% of their imports. Now it's up over 40%. From the most recent estimates. So that's a massive amount of income for Putin. That's keeping this war machine going. And the president said yesterday that he'd talked to Prime Minister Modi. Modi said he was going to reduce them. There are reports that our brand new ambassador to India, Sergio Gore, who's known to be very close to the president, has met with the prime minister and discussed this. If we can get the Indians to reduce those imports the way we did with them in the first term when they were importing so much Iranian oil, that's a big stick, not a carrot, for Putin. That may be what's actually going to bring him to the table.
Another big stick potentially is sending Tomahawks to Ukraine. There's going to be a weapons discussion today in the Oval Office. What do you think the outcome is going to be, Victoria?
Well, we'll see. I mean, that would be a big step. The Tomahawks obviously can strike much deeper into Russia, potentially hit the launchers that the Russians are using to attack Ukraine. It's going to be up to the President, Secretary of War Hegseth, if they decide that is a good strategic move for the United States. I mean, the problem is that while we do have a significant stockpile of Tomahawks, they're not limitless. They're expensive. They take a while to make. And so we have to be very careful to balance what we're giving to Ukraine with what we might need in the Pacific in the event of a conflict potentially with China.
Yeah, they cost nearly $2 million. If the president was to offer these Tomahawks, what do you think the signal would be from Russia regarding this?
Well, for Russia, I mean, this would be, a major step and a potential escalation. But bear in mind, Russia has also been escalating in Europe. They've been sending drones, even MiGs, over some of our NATO allies, Estonia, Poland. So they've been pushing at the boundaries as well. And so for the president, that'll be a strategic decision. Does he want to push back on Putin the way he pushed back on Iran with the B-2 strike in the spring, when they had just kind of dragged that diplomatic situation out to the point that he didn't think there was a diplomatic option on the table? And he has given Putin every diplomatic opportunity to come to a resolution of this war. It's going to be when he makes the decision. Putin is just being obstreperous. He's not going to come to the table. Does he want to take that next step, which would be the Tomahawks?
Victoria, you've worked with the president. Could you share with us his approach to moments like this? Because it's often said that typically when heads of state get together, 99% of the work has been done by diplomats. Heads of state sit down, sign a deal. But with the president, it's often described that he approaches these moments almost on the fly, that nothing's been agreed. He wants to see the person face to face. What's your experience of how it actually goes down?
Well, that's not entirely accurate. There are going to be a series of meetings this week between top-level diplomats. I expect Secretary Rubio, Steve Witkoff will get together with Russian counterparts, discuss where they are in their calculus. This will give the president some context for where Putin's head is when he goes to Budapest. And then, but at the same time, I do think you're correct. He does try to go in without a lot of kind of preconceived parameters. He wants to see what's possible. He has an incredibly strong nose for people. He can just kind of figure out where they are, what might be done. And he's said over and over again, he wants to end the killing. He wants to end this grinding, horrible war. And so if there is a path there, if Putin is feeling the economic pain, if he's concerned about the situation with India, maybe there is an opportunity that there wasn't when they met in August in Alaska.
Victoria, appreciate your time on the programme today and your experience. Thank you. The former White House Deputy National Security Advisor, Victoria Coates, hopeful that Budapest can be different to the Alaska that you experienced on the ground.
Right, and Alaska was really what you're describing in terms of the president taking this starting gun approach. I'm going to meet leader to leader first, then the diplomatic work can trickle down. There will be Secretary Rubio heading over, but the president wants to sit face-to-face with Putin after today. He sits face-to-face with Zelensky and really debriefs him on this phone call. We just heard from the Kremlin that Putin got off the phone with Viktor Orban. Potentially, are we seeing contours of a group of these leaders getting together? Because really, for this war to end, it needs to be a trilateral. You have to have Putin, Zelensky, and Trump in a room.
That's the latest on foreign policy. If you're just joining us, of course, an additional focus on what's happening with the regional banks. We're getting some earnings this morning. This coming from Comerica. Net charge-offs, $32 million. The estimate, $28.6 million. Nothing too scary about that number right there. Net interest income was a beat, $574. The estimate was $569.3 million. We get a range of earnings from regional bank lenders in this country throughout this morning. A lot of focus on that, given what happened with Zions and Western Alliance yesterday, and the kind of moves it triggered in the broader market. Some negative follow-through this morning. Futures down by 1% on the S&P. Up next on the show, we'll catch up with Ian Harnett of Absolute Strategy Research on another massive AI deal, adding to bubble concerns. Plus, Danny is back. She's got your morning movers with growing credit fears, sending bank stocks lower. know it doesn't feel like it, but coming into Friday, actually heading towards a week of gains. We've just had these massive swings. Another 1 percentage point swing in yesterday's session, and this morning we're down across the board, threatening to take out those gains. We're down by 1% on the S&P. On the Nasdaq, we're down by 1.3. In the bond market, at the front end of the curve, a move of more than 10 basis points so far this week, 4 of which come this morning. 338 on twos, new lows for 2025 across the board, potentially here. 10s at 394.76 and down 3 basis points on a session. And if you want to rally a bigger one, check this out. In the gold market, a 6th consecutive day of gains, up 1/3 of 1%, heading towards a 9th straight weekly advance for gold. The longest weekly winning streak going back to 2020, and this week higher by 8%.
And you can see why, right? You have loan blowups in the United States that everyone is looking at whether or not this is idiosyncratic and independent, or potentially is it more systemic? Are we going to see more cracks, more cockroaches? At the same time, what is going on in the macro environment? The two biggest economies right now are at loggerheads, trading hot rhetoric, and yet we do not know what the end game is going to be when the president sits down with Xi Jinping. We think there's going to be an off-ramp, but we don't have that just yet. So this is why. Where else are you going to go? It's a haven trade.
43.37 on gold so far this morning. That story just keeps on moving and moving higher. From New York, welcome to the program. That's the cross-asset setup. Let's get you some single names in the pre-market, some morning movers. Here's Danny. Hey, Danny.
Hey, John. Has another little critter or two scurried out from underneath the fridge. This morning, the sell-off continues in Zions and Western Alliance, both those regional banks earlier this week, taking a $50 and $100 million write-off, respectively, tied to loans gone bad. This was regarding a distressed real estate developer, but it has echoes of Tricolor, of First Brands, of alleged allegations of fraud, of collateral that maybe wasn't there. And Annmarie, as you put it, the question is going to be, are these cockroaches or are they termites that have chewed through the foundation? But we are selling first and maybe deciding on those questions later, because you're also looking at the big banks taking an even harder hit this morning, whether it be Bank of America, Citi, Wells Fargo, all of them down at least 1%, nearing 2% for both Bank of America and Citi, despite the fact that they reported earnings that had better credit quality than quarters past. It's not just the big banks, it's also private capital firms that are being hit hard this morning too, those that have big private credit operations. KKR down 2.5%, Ares down 1.6%, Apollo down 2.4%. Of course, all of these and a lot of private credit managers have been very vocal. We are not the cockroach. The banks are the cockroaches, including my conversation with Blue Owl earlier this week. But even so, all the financial services sector is taking a hit, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. More earnings for you. These come from Fifth Third. Fifth Third, of course, in the news more recently for taking out Comerica. Interested in net interest income. That comes in at $1.53 billion. The estimate was $1.52. Provision for credit losses, a number that's going to take an increased importance, of course, given the events of the last 24 hours. $197 million. The estimate was $239. We'll keep tracking that story for you throughout this morning. On our radar this morning, our top story, regional bank stocks sinking with credit concerns weighing on global equities. The slide following Zions and Western Alliance reporting fraud on loans tied to distressed commercial mortgages. Those names again, just slightly so far this morning. Elsewhere, a major relief for the auto industry. Sources telling us here at Bloomberg, the White House is aiming to grant car makers a 5-year extension on tariff relief for imported parts. A big win for the likes of Ford and GM after months of lobbying. And finally, the White House teasing another summit between President Trump and the Russian leader. The news coming after a 2-hour phone call between both of them. President Trump is set to meet with Ukrainian President Volodymyr Zelensky later on today.
And then in 2 weeks, he says, or about 2 weeks, he's going to be sitting down with President Putin. At the same time, the Kremlin just came out and said Putin just spoke to Viktor Orban, where the president is going to be meeting Putin in Budapest. So behind the scenes, there's a lot of work and momentum potentially driving ahead to try to put an end to this war. Even Democrats this morning, Jonathan, Rahm Emanuel in the Wall Street Journal talking about after a success in Gaza, Mr. Trump standing on the global stage has never been higher. Some of them are saying, though, do more. That sanctions package that's been lingering in Congress, put that forward. Send Ukraine the Tomahawks. Give them everything they need to defeat Putin. At this moment, the president has been 2 steps forward, almost 1 step back when it comes to trying to cajole him to the table.
We talked to Victoria Coates just moments ago. She'd worked alongside the president years back, and we talked about the increased leverage he might have given the success in the Middle East. It's an anti-war president who's not afraid of using hard power. I think it's important to talk about this. If he doesn't have success at a Budapest meeting, if it looks like something that we saw in Alaska. What's the next step for the president and this White House?
I think he starts to rearm Ukraine in a bigger way. Those tomahawks, maybe they're on the table today for discussion. Maybe they don't get delivered. But if this meeting fails, potentially he doubles down on backing Zelensky. Remember, this entire year, February 28th, that meeting in the White House between Putin and Zelensky, I was at the White House. That was a massive blow-up. Then in August, Zelensky came back, and you saw a much warmer approach between these two men. And even the president coming out and saying things like, I see where he's going, I see his side. So potentially, you're going to see him really double down on backing Zelensky if this Budapest meeting falls.
Look out for that meeting later on today between the Ukrainian leader and the president of the United States, Donald Trump. Let's turn to tech. Sources telling us here at Bloomberg that Meta and Blue Whale are set to seal a $30 billion private capital deal for an AI data center in Louisiana. Ian Harnett of Absolute Strategy, writing in the Financial Times recently, the AI bubble looks to be approaching its endgame. But history shows that a bust triggered by this overinvestment may hold the key to the positive long-run potential of AI. Ian joins us now for more. Ian, welcome back, sir. Been trying to make this happen for a while, so appreciate your patience.
Yes, we have, Jonathan.
Let's get to this story. Why do you think we're approaching a so-called endgame?
So I think, if you look at what's been happening in the AI stocks, we've got all the classic symptoms of, a bubble. I do think it is a bubble. We've outperformed since 2016. The FANGs Plus index has outperformed the global stock market six-fold over. The TMT bubble only saw a five-fold increase, Jonathan. We've got exponential share prices. Companies are using those share prices to do deals with each other. They're buying each other's goods, and they're even lending each other money to do so, that vendor financing. So the key final element of any bubble is always this overbuild of capex, and that's really the bit that we're seeing now. And I think it doesn't mean that the AI bubble is going to stop tomorrow, or maybe not even 6 months' time, but the end game is definitely coming in place here.
So, Ian, when you compare this moment to what happened in the late 90s, and you think about the companies central to this moment versus then, the companies now have incredibly strong balance sheets. When you say endgame, I'm sitting here thinking maybe this can go on for a whole lot longer than people realise.
So, Jonathan, the thing that we always try to remind our clients at Absolute Strategy is that, the theme may be structural, and the companies that are winners will probably be the winners in the future. But two things to bear in mind. First of all, the companies that are the winners in the digital age today, Microsoft, Amazon, Oracle, Apple, they all lost between 65% and 95% in the tech blow-up. And Microsoft took 16 years to get back to its 2000 level. So there's a price for everything. The second point is the structural story, the theme. It's going to stay there. It's going to be there. AI is going to be. But the problem is that your clients need to have the cash flow. So the theme can be structural, but in the end of the day, the economy and the clients of the AI businesses are going to be cyclical, and that means that somebody's going to run out of cash at some point. So cash flow is absolutely key here.
Ian, you also talk about how tech busts have more negative economic impact when it's funded by debt rather than equity. Can you explain what potentially that can look like if this bubble bursts?
Well, I think that, if you look at the scale of the bust that we saw around the GFC and the debt, losses that were imposed there, debt deleveraging is a very damaging process. Equity bubbles, as we saw in 1987, 1998 with LTCM, you can probably recover from those relatively quickly. And even the tech blow-up, you did come back from that relatively quickly. So the economic cost, I think, tends to be less. But the dangerous lesson from history is that if you are the equity holders funding this kind of accelerated capex build-out that takes place when people get crowded into these bubble themes, you typically lose around about 70 to 80% of your capital. So, funding this via equity rather than running, just as Jonathan was saying, if these companies were only using their own cash, then that would be great. But they are using other people's money as well.
And I wonder what GDP would look like. If you look at GDP at the moment, just how dependent are we on that capex story already?
Yeah, we're very, and this is something that our chief economist, Dominic White, has been highlighting to clients as well, that, almost half the growth in the US economy so far this year has actually come from this AI-related capex. So it's almost as large as total US consumption spending. So this is the first time we've really seen that scale of capex driving GDP growth like this. So, yeah, you'd be in a very different situation, I think, Jonathan, if we didn't have this. And this is one thing why we should celebrate this kind of bubble, why we should celebrate this kind of capex, but recognize that it doesn't go on forever, and there are limits to how strong you can see this performance go on for, and how long it can last as well, typically.
So, Ian, just finally, this is your framework for thinking about a pretty important moment and a major transition. What's your approach? What are you advocating for in financial markets, given everything you've just said?
Well, at the moment, we're still overweight equities, partly because you're seeing an administration that wants to cut interest rates into double-digit earnings growth. Historically, that has been very positive indeed. But what we're saying is watch out for those early warning signs. Watch out for nominal growth, nominal earnings, but most importantly, Jonathan, nominal cash flows. When those start going down, and particularly the cash flows of the people that are buying the AI services, then that's the point at which you want to be thinking, well, maybe I want to be in something else rather than some of those tech stocks and some of those highly geared plays in the equity market.
Ian, appreciate your time. It's good to see you again. It's been far too long. Thank you, sir. Ian Harnett there of Absolute Strategy Research on the equity market. Equity futures this morning down by about 0.9%. We've got a lot of news flow to deal with. Let's get your top stories in your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Well, the US government shutdown is in its 17th day with no end in sight. Senate Majority Leader John Thune is trying to entice Democrats to support reopening the government by promising a vote on Affordable Care Act subsidies once the shutdown is over. So far, the offer has not been enough to get the needed 5 Democrats to pass the GOP-led stopgap funding bill. The consortium buying video game maker EA is set to add more than a dozen banks to its underwriting group. This comes after JP Morgan put up $20 billion of debt to bankroll the leveraged buyout. Around 15 banks are likely to join the underwriting group, with some taking around 10% of the deal apiece, while JP Morgan will keep around 40%. IKEA is boosting its US production after President Trump imposed tariffs on furniture and kitchen cabinets. The retailer currently produces around 15% of products domestically. IKEA plans to invest $2.2 billion in new stores and production facilities. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, complacency turning to concern.
The problem is investors have been used to this environment of low volatility. The volatility, the price discovery in the market is being suppressed for a very long time, and investors have misallocated capital to vehicles that don't have mark-to-market.
That conversation up next with Chris McGratty of KPW from New York City. You're watching Bloomberg TV. Equity futures on the S&P 500 down by 0.9%. A bit of tension building in the last 24 hours regarding credit and credit risk. The Nasdaq 100 also participating in the downward move, down by 1%, and the underperformance from the smaller players, the small caps this morning, down by 1.25%. Under surveillance this morning, complacency turning to concern.
We're at a 30-year tie in credit spreads, and this has been fueled by monetary liquidity and fiscal spending. The problem is investors have been used to this environment of low volatility. The volatility, the price discovery in the market is being suppressed for a very long time, and investors have misallocated capital to vehicles that don't have mark-to-market. We believe there's going to be more pain in the coming quarters.
So here's the latest this morning. Credit fears growing on Wall Street. Zions, Western Alliance, both disclosing loan fraud losses, sending regional bank shares plummeting and triggering fear across Wall Street. Herman Chan of Bloomberg Intelligence joins us now for more. Herman, welcome to the program. Just in very simple terms, what did we learn yesterday from these two banks?
We learned that there was a couple of loans that the two banks in question had exposure to, but they should be fairly small, relatively small losses, and the contagion fears seem to be a bit unwarranted given the fact that we've seen a slew of regional banks report this morning, and we've had regional banks report over the past couple of days. that showed credit quality is really stable and solid. So there's a lot of fear in the marketplace given the fraud issues that are really hard to screen for. So that's really driving the anxiety today.
David George of RW Baird said something similar, Herman. He said to take advantage of today's weakness in the bank group, and he upgrades Zion to outperform. Says market participants are fighting the last crisis. $1 billion market cap decline, over $50 million in losses seems a bit excessive. Herman, can you comment on that? Fighting the last crisis. Are we more spooked by this because of what happened in the past few years?
I think so. I think the scars from the SVB issue and the other banks that failed really are on top of mind today. But I think this is a different issue, right? This is a credit issue, not a liquidity and deposit flight issue. And the banks have really strong capital that they've built up since the SVB crisis. And we think that these issues are a bit more one-off in nature that can be readily absorbed. Nonetheless, the contagion fears have affected the marketplace today.
Herman, thank you. Herman Chan. That fear continues. Thank you very much. Chris McGratty of KBW writing the following. The market is becoming increasingly concerned about credit quality, with now 3 prominent bankruptcies shaking investor confidence. Chris joins us now for more. Chris, welcome to the programme. Before we get to these flashy headlines, Chris, can we spend some time just focusing on the details, the work that you do? When you look at a company, a bank like Zion's, net charge-offs, non-performing loans, how good is the credit quality at that bank?
Well, Zion's balance sheet's in a great spot, right? They had an unfortunate credit announcement this week, but if you look at the balance sheet more comprehensively, non-performing assets are 1% of total assets. So we're off very low levels. Now, this normalization process that we're talking about, we're coming off of multi-year lows, and so that process can be painful when you see losses like this. But if you think about the capital position of the company, the credit quality of their portfolio, we think they're in a great spot. And more broadly, we think the industry's in a really good spot.
So, Chris, why do you think these more flashy headlines in the last 24 hours have spooked people to such a degree when you're able to break down the strength that you see elsewhere in the majority of the bank?
Right. The market sells first and asks questions and figures it out later, right? We saw that during 2023. This is completely different, right? So bank balance sheets are in a great spot. The market just doesn't like uncertainty. And so we've done a lot of work on the theme of consistency. The market loves consistency. If you look at the large banks, the earnings they've reported this week, they've been excellent. JP Morgan, Morgan Stanley, these companies, Wells Fargo, the ROEs of these companies are high teens, and they're very consistent. And so what our conversations have been with investors is let's stay up cap. Let's during this period of volatility, let's hide out in banks that have the ability to diversify the earnings through the capital markets. And over time, we're going to get opportunities in the mid caps.
So, Chris, this is an important conversation. Where do you hide out? That really is going to be led by where is the risk. Chris, where do you think the risk is when we're talking about Tricolor, when we talk about First Brands, the events of yesterday? If there is a credit cycle turning, where do you think that risk lies?
Well, I think that the common denominator in all 3 of these prominent credit incidences has been private credit. So private credit's been a really fast-growing asset class for the last decade. The bank's balance sheets, again, some of the effects of deregulation and regulation since the financial crisis has been pushing risk to the non-traditional banks. So there is a dynamic between banks and non-banks and who holds the credit risk. But overall, I think we need to bring it back. Underwriting has been very good. Yes, credit spreads are low, and yes, we are seeing these headline losses. But the industry has made tremendous strides improving the credit quality.
Chris, a lot of people are talking about how this is deja vu to the Silicon Valley bank collapse in 2023. Is it similar in your view?
I mean, the stock moves are, symbolic of it, but this is a completely different situation. That was a liquidity, deposit uncertainty, volatility, and that was a pretty, volatile period for markets. This is a handful of credits, and again, it all starts. Generally, cycles start with stuff like this, but this is totally different. Bank balance sheets and credit quality are excellent. Again, I'm going to underscore that point. Liquidity is something that can happen very quickly. This is not a liquidity event.
Chris, to the extent that one informs the other, I just wonder if, because of what happened last time, faith in management teams was shaken back then, and I wonder, Chris, if that's what's happening now. That there's a lack of faith in management teams because of what happened back then and how those issues were dealt with. Chris, are you saying that lack of faith is misplaced?
Well, I think it's, I think there's confidence in the management teams. I think there's a little bit of uncertainty in just the day-to-day market volatility. So, returns have been pretty good. They're moving directionally higher. The banks have been transparent about where the losses may lie. And so this is a market, I view this as a market uncertainty when you're seeing these headlines come through. But if you kind of zoom out and look at the earnings reports that we've seen over the past week, the returns and the numbers have been very good. Right, there's a handful of credits that are destroying confidence temporarily, but that's kind of when you make your money in banks, is when volatility is high.
Chris, in 2023, with the funding crunch, we heard a lot from the Treasury Secretary, regulators came out. Do you expect the same kind of response in this situation?
I don't think we do. I don't think we need a response. I think the numbers speak for themselves thus far this quarter. And again, we are going through, next week will be more of the mid-cap earnings. I would expect general results to be pretty good. I don't think you need intervention every time there's a little bit of a hiccup in the market.
Chris, there is a hiccup. How do you take advantage of it? If you were looking to buy this morning, where would you buy?
Well, look at some of the banks that reported yesterday, right? Citizens Financial reported earlier this week. KeyCorp reported earlier this week. These companies are trading at 7 times earnings, and they're on pace to produce 15, 16, 17 returns on equity. That's a mispriced situation. So you can pick your spots in the regionals. And if you are a little bit more risk averse, the large cap banks, the universal banks, the ROEs are much higher. They're much more sustainable. You do pay a premium for that. But again, over time, consistency pays.
The numbers this week from the major players, just absolutely phenomenal. Chris, appreciate your time. Thanks for joining us. Chris McGratty there of KPW. There is a move from some, particularly in the analyst community, who are looking at these banks on a daily basis to say you should buy some of this weakness. I mentioned David George of RW Baird. Allow me to share this quote with you, just on the management of Zion. Fundamental trends are solid at that bank. Strong historic underwriting quality should limit further losses. This bank was really shaken yesterday, and it looks at 10-year performance, 2014 to 2024, and says that Zion has averaged net charge-offs of around 0.12% of loans on an annual basis, one of the best in the bank group. Goes on to say, good underwriting relationships and disciplined loan growth over the past few years suggest that lower credit risk from our perspective, creating a buying opportunity following the market reaction of the last 24 hours.
As what Chris just said, this is a hiccup. So you can almost see the end of the day where you see regional and some of the large players actually rally because so many people sold, asked questions later. This morning, they're recalibrating, they're asking questions. They're digging into actually what these banks look like. And they're saying, this is a real buying opportunity. This is idiosyncratic. Chris is there is talking about it's not a liquidity issue the way we had in 2023. So potentially this is the time now to get into the market.
It's funny. It's odd that we just had this week of fantastic earnings from Wall Street and we're ending it by focusing in more on the bad than we are the good. And I understand why. It's been good for a long, long time and people are worried that maybe some bad loans were made in the good times. I get all of that. But a lot of this comes down to Jamie Dimon of JP Morgan changing the conversation. Coming out and saying there's more cockroaches, that's going to get people feeling very antsy about what's happening.
Exactly. He came out and said, you see one of these, there's got to be more. So now anytime there's a potential hiccup in any of these banks, people are going to start to worry. Was this what Jamie Dimon was seeing? Was he foreshadowing this potential, not just idiosyncratic moment, but more systemic risk and contagion? I wonder if he didn't say that. Would we be seeing this sort of market reaction across the board? I'm not sure.
He certainly turned the volume up on the conversation, let's put it that way. Western Alliance this morning down by about 2%. Zion's just slightly negative. Coming up on the programme, we'll catch up with Liz Ann Saunders of Charles Schwab, the IIF President Tim Adams, Steve Pagliuca of Bain Capital, and the Dutch Central Bank Governor. That's all in the second hour of Bloomberg Surveillance. The second hour is up next.
We know that labor demand is cooling.
The weakness in payrolls is ultimately why you're getting rate cuts.
The market, of course, is pricing in a very aggressive path of cuts between now and the end of next year.
The big risk is that the Fed does too much too quickly.
I definitely think there's going to be more discussion around the December meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P negative by 0.8%, off session lows. The Nasdaq still down by 1%. Big moves in the bond market in the last 24 hours. Across the curve, 2s, 10s, 30s. 2s at the very front end of the curve at 340, down 2 basis points on the session. 10s breaking below 4%, a clean break, 396.48 this morning. We're down about a basis point. And these two names responsible really for the price action of the last 24 hours. Western Alliance and Zions. This morning, down marginally by 0.6% on Zions. Western Alliance down by 2.1%. Yesterday, down dramatically.
Shaking investor confidence right now. What's going on and the concerns in the credit market, the fact that these two banks saying they were victims of fraud. But when you hear from Herman and you hear from Chris, you feel like there's going to be a turning point today, because they're saying when you dig deeper into actually the balance sheet of these banks, they're buys. And the banking sector right now is in good condition, even though there are these concerns. And you bring up a great point. Is everyone just focused on the concerns because Jamie Dimon did tell us, look for those concerns?
The concerns are legitimate. I think that the Dimon comments turned the volume up on the story this week. We've been talking about First Brands and what happened with Tricolor for quite a while now. But yes, you're right. In the last 60 minutes, we've heard from a group of people who've said, look at the balance sheets, they're strong. Look at the credit quality, it's strong. But over and over again, there's a worry about a turn in the credit cycle. That's why people are nervous that we've had good times for a long time, and the worst of loans are made in so-called good times. And is this just the start of more to come?
We heard from John Waldron of Goldman Sachs, and he said the risk of a two-speed economy and that the recent blowups might indicate that those in the lower end of the economy are suffering, and there's been a lot of lending in there. So I also think when you take a step back, this is just indicative of the K-shaped economy we have been talking about for months on end.
As the US session comes online, futures are starting to build on gains. We're still negative on the day, but well off session lows on the S&P 500, down by less than 1%. We're down by 0.75% so far this morning. Coming up this hour, we'll catch up with Liz Ann Saunders of Charles Schwab as investors grow wary of credit stress. We'll talk to the IIF President Tim Adams as that worry spreads to global markets. And we'll speak to Steve Pagliuca of Bain Capital, with more banks joining the massive EA buyout. We begin this hour with stocks sliding as hidden credit worries intensify. Joining us around the table, Liz Ann Saunders of Charles Schwab. Liz Ann, good morning.
Good morning.
Anything to worry about? This is all kind of building up, these one-off events, the fraud at a couple of banks, Tricolor, First Brands. How are you approaching this moment?
So I think when you look at now some of the strains in the regional banks, and you think back to the 2023 period, the mini banking crisis, there's been a spread since then that has, again, to the K-shaped aspect, where regional banks are sort of seen as this separate little thing. I think the benefit to having this happen with Zions and Western Alliance is it occurred during a week where we were getting larger bank earnings. So that provided, I think, the continuation of that bifurcation between the regionals. High yield credit spreads broadly have been fairly well contained. I think, the CEOs, leaving Jamie Dimon's comments aside, are going to be peppered with questions by analysts to see whether there's an infection here. Wouldn't surprise me if, like was the case in 2023, this leads maybe to a bout of some consolidation and maybe some acquisitions of some of the regional banks.
It's funny, just to stay on theme, that all these comments about private asset managers, we're not talking about Apollo, KKR or Blackstone. We're talking about Western Alliance, right. We're talking about Zions, and in fact, we were talking about JP Morgan and their exposure to some of the stories of the last weeks. When you're thinking about, okay, there might be risks, there might be some so-called cockroaches, how do you think about where they are? Where are they and what do you want to be avoiding?
I think what you want to be mindful of are at the factor level. If you're a stock picker, consider factors like strength of balance sheet and high interest coverage and low debt to equity. I think that's, instead of trying to find where the cockroaches are, maybe provide some protection within portfolios by going up the quality spectrum in areas specifically where they're less likely to have some of these troubles.
Is up in quality and up in market cap the same thing?
No, not necessarily. In fact, I think up in quality is even more important down the cap spectrum. So when you look at the Russell 2000 and you look at the 57% that are profitable, the 41% that are not profitable, by the way, I know that doesn't add up to 100. There's 2% of the Russell that just doesn't have, they don't provide earnings. You can't get data. But the performance on a year-to-date basis of the non-profitable component is about double what it is in the profitable component. So you have seen this bias and retail trader bias down the quality spectrum into the non-profitable areas. You see it in baskets like non-profitable tech as well. I think that's where you want to go up in quality. Again, look for strength of balance sheet, look for actual earnings growth and positive earnings revisions, profit margin stability, and those lower leverage type companies.
So it doesn't mean you just have to stick to the big banks. There's still regionals out there that are good.
Yeah, I think that's the way to think about all sectors. I think it's you have to be careful about taking a monolithic approach to investing at the sector level, at the industry level. And that's why factor-based investing adds so much value, because you can go into the characteristic level and look for opportunities, especially in the midst, or maybe even providing an opportunity when you have sort of babies being thrown out with the bathwater. It gives you an opportunity to sort of pick off some of the higher quality areas.
Why the swift reaction across the board, including even global markets, when it's these idiosyncratic to regional U.S. banks?
Even before this happened, that there was some skittishness that you were starting to see in the market, churn under the surface, more rotation, speculation that was moving out of the major indexes. And here's another peripherally good story, is a lot of the speculative fervor has been outside the mega cap tech areas within the market into these micro level baskets. I mean, even the micro caps within the Russell, way down the cap spectrum, were outperforming the index itself. Quantum and drone and meme. And I think there's been this concern about too much speculation in certain pockets, ongoing valuation concern. You had started to just see some agita underneath the surface of the indexes, and then you get a piece of news that sort of exacerbates what I think was already a little bit of a background story even prior to this.
It's a market stacked with contradictions. It's an economy stacked with contradictions too. Governor Waller was in your seat just yesterday, and we were talking about how good employment, or rather how good retail sales was, and how bad employment is. You've got this massive step down in payrolls, but everything else in the economy seems to be okay.
Yeah,
Do you think that can persist?
Well, the payrolls thing probably has a lot to do with immigration. And everybody is out, all economists are out trying to figure out what the break-even rate of payrolls is. Prior to the compression of immigration, numbers were around, you needed 150,000 payroll jobs a month in order to keep the unemployment rate from rising. I've seen numbers as low as 0. I would say consensus is somewhere in the 50,000 range. So I think we have to take immigration or lack thereof into consideration when looking at payrolls. But I also think there's a size differential too. I think in keeping with the K-shaped, a big difference between the employment outlook, the CapEx outlook, the earnings backdrop down the size spectrum. And that's why one of the things that's interesting that didn't get a lot of press is when we got the second quarter GDP revision. And I know that's very rear view mirror, but so it was a very positive revision. Sure. GDP up from 3.3 to 3.8. Most of that was stronger consumption. But the national income and product accounts version of profits, which is much larger than S&P profits. It covers millions of companies down the size spectrum into S-corps. So it's a much more comprehensive look. After-tax profits based on that measure were revised down into negative territory for Q1 and Q2, relative to 13% or so for the S&P 500. For what it's worth, NIPA-based profits tend to lead S&P profits. There have been divergences that have not resulted in S&P catching down to NIPA-based profits. That happened in 2018. But it does tell you that there is more stress being felt across the spectrum of companies, which maybe you don't pick up when you're just looking at S&P profits. That's not really a proxy for how the country is doing at the business level.
That suggests that maybe there's some underappreciated risk into 26 for market price for reacceleration. Is that fair?
Yeah. So I think, coming into this quarter, the bar is probably still set sufficiently low, although analysts did more raising of estimates in the lead into the start to third quarter earnings season relative to what they did or did not do in first and second quarter. So there wasn't a commensurate extrapolation of the strong first half into the second half. But that trend has picked up a little bit. And you're right. I think one of the risks in this environment is not that earnings will disappoint in an absolute sense, but you might have some high-profile misses relative to an elevated expectations bar. And I'm almost 40 years doing this, and I'm fond of saying that better or worse matters more than good or bad.
It's true.
It does.
Lizanne, it's good to see you.
Good to see you.
As always, thanks for being here in New York. Lizanne Saunders there of Charles Schwab from New York City. Equity futures are recovering. As the session grows older, we're down by just 0.6% now on the S&P. With an update on stories worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John, thanks. Well, let's recap. The KBW Regional Banking Index falling to the lowest levels since August after Zions and Western Alliance said they were victims of suspected fraud on loans tied to distressed property funds. 74 of the biggest US banks shed more than $100 billion in market value in yesterday's session. Shares of Eli Lilly and Novo Nordisk are falling after President Trump said the price of diabetes drug Ozempic could come down to $150 a month. The US list price of Ozempic, which Trump calls the fat loss drug, is roughly $1,000 for a month's supply. Lilly sells similar treatments, including Wegovy and Zepbound. Apple getting ready to launch a touchscreen version of its Mac computers. The new laptops will have displays with OLED technology and a full trackpad and keyboard. The touchscreen Mac Pro is expected to be released in late 2026 or early 2027, with prices likely to be a few $100s more than current versions. So that's your Bloomberg Business Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next, cracks in credit.
You're starting to see things that feel late cycle, and I would feel quite strongly that we're in the latter innings of a credit cycle. The problem when being in the latter innings, you don't know if you're in the 6th inning or the 9th inning, and no one will ever know until afterwards.
That conversation up next with the IIF president, Tim Adams, live from New York City this morning. Good morning. Live from New York, welcome to the program. Check out the equity market. Futures recovering by quite a lot. We're down by just 0.3% now on the S&P. On the Nasdaq, down by 0.5. There was a question earlier this morning about whether the move in banks was overdone. But also, in addition to that, just in the past few moments, the president's been speaking to Fox News earlier on this morning. They've released some of the headlines from that interview. And the headlines suggest, let's just say this, and I know this can go switch and back and forth to heightened tensions, lower tensions, but a more constructive tone coming from the president on tariffs on China ahead of his meeting with the leader at the end of this month.
His hand, Jonathan, is on the knob right now, and he's lowering the temperature. When asked about the 100% tariff threat, he's basically signaling, no, that's not going to stand. He's saying we're going to be fine when it comes to China. He's going to sit down with Xi Jinping. Maybe we do not get the grand bargain deal, and maybe you don't get all of these issues that the United States has with China wrapped up in this one meeting. But it does look like both of these economies are looking potentially for an off-ramp. And the issue really this administration has is the fact that China is making it much harder, much more expensive to get access to rare earths.
That's just helping to support sentiment, those comments. We're down by just 0.3% on the S&P. If you turn from equities to bonds, see the move unwinding there too. 2-year bond yields now just about unchanged at 342. 10's now up a single basis point, so that's a change as well. 398. On 10 so far this morning. We'll keep tracking that story for you. Under surveillance this morning, the big story in the last 24 hours, cracks in credit.
Equity valuations are very high. Credit spreads are very tight. You're starting to see things that feel late cycle, and I would feel quite strongly that we're in the latter innings of a credit cycle. The problem when being in the latter innings, you don't know if you're in the 6th inning or the 9th inning, and no one will ever know until afterwards. We're just being a lot more cautious in how we think about credit.
So here's the latest this morning. Traders turning risk off in the last 24 hours on concerns about increasing cracks in the credit market. On that story, Lisa joins us now from Washington with a special guest. Good morning, Lisa.
Good morning, John. It's great to see you and Annmarie talking about both credit cracks as well as the trade uncertainty, because it's what's really been dominating the conversations down here in Washington, D.C. I am joined by Tim Adams, who is the head of the IIF, the Institute for International Finance. You've been going around the world. You've been talking with 1 million people this week. You are exhausted after all of this. How much are cracks in credit markets or some sort of concern about a real kind of credit event? How dominant is that in your conversations?
Well, first of all, thank you for having me on this Friday morning. It's great to be here with you. Actually, not much at all. Most of the conversation here this week in Washington during the bank fund meetings and our own annual meetings is really about bigger issues: geopolitics, U.S.-China relations, AI, technology, stable coins. It really has not come up in a single conversation that we've had this week.
Although on the greed versus fear metric, right, this is sort of going to the same question. Do you get the sense that a lot of CEOs of banks, a lot of finance leaders feel like they might be missing out on profitability still, rather than worried about what they aren't seeing with respect to credit risk, with respect to fraud?
What I have heard are foreign banks coming here this week noting that the U.S. is open for business. In fact, they're a little jealous of the environment, the regulatory environment that's evolving here. And I think Scott Bessent and this administration does a magnificent job of signaling to the financial services industry, we want you here, we want you healthy and profitable. That's really dominating the conversation.
So this isn't really necessarily a feeling that maybe things have gotten a bit too far, that maybe there's this dissonance between really easy financing conditions in the United States, along with not only uncertainty with respect to trade, but also a backdrop of a weakening labor market that has certainly the Fed somewhat concerned.
You know, the perception is the U.S. economy is pretty resilient. And, you know, it's not perfect. There are certainly weaknesses. But given what the C-suites have gone through over the past 9 months, this seems pretty trivial, right? We've gone through a whole year of shock and awe, enormous uncertainty. Where are tariffs going to end up? Where's U.S.-China relations going? That still exists. And I think that dominates the C-suite more than do we see cracks in particular parts of the credit cycle.
We saw this morning, and Annmarie was saying that President Trump is turning the dial down when it comes to some of the rhetoric between the U.S. and China and just what's at stake here. We know that the automakers have been very concerned about losing access to rare earth minerals and what that could do to manufacturing. Is there a sense in the C-suite that there is a new normal and that there are certain places that the U.S. and China just will not go, and they can kind of create business around that?
So we're still waiting for the new normal. The old normal's gone. Something new's coming. There will be a new equilibrium at some point. But right now, it really is kind of chaotic. But C-suites have gotten used to the chaos, right? Their job is to manage through this, right? Even if you don't know where we're going, you still have to learn how to drive. And I do think there's a perception that despite the animosities that may exist, the dissonance between Beijing and Washington, delinking or uncoupling really isn't pragmatic or practical in the short term.
You sound so optimistic. And I have
it's Friday.
to say, well, it might be Friday, but this morning the discussion is all about what might be emerging. The fact that you could have weakness in the economy, the fact that credit standards have gotten very loose in the United States, that when Wall Street demands a product, when they want income, well, when investors want that, Wall Street will create it for them, even if it means at the risk of lowering some of the credit standards. How do you square this?
I'll take off my optimism.
Okay. Well, I'm just curious. How do you square these things?
Look, there's no doubt that we see softness in the labor markets. Corporates are not hiring for a whole host of reasons. That's a challenge. We have a labor supply problem that isn't going away anytime soon. And tariffs are going to work their way through. I know some people in this town say they don't exist, that economists are wrong. They're not wrong. It just hasn't happened in the magnitudes we thought. So there are a lot of challenges to this economy, especially for low-income consumers. But the markets and the wealth effect and high-income consumers are driving this economy, and they're going to keep driving it as long as we have buoyant markets. And I don't see that going away in the short term.
How much do international banks, international finance companies right now seek to diversify away from the U.S., keep other channels open and expand them, whether it's Middle East to China, whether it's just Europe to the rest of the world, in a way that feels different to you?
That's a great question. In fact, what I've witnessed over the last 6 months is a great reshuffling of the global economy, a reshuffling of capital flows, trade flows, new relationships. People are getting out of their offices, getting on planes and going to new destinations to create new alliances, new relationships, and new trade deals. The world is not being static. People are looking for opportunities, whether it's in the Gulf or Africa or the ASEAN countries. The world moves on, and it's rewiring itself.
Do you get the sense that there is a shift away from the dollar, in the sense that is beyond just the price of gold, that is beyond just lip service, that is beyond just using derivatives to hedge the risk of some sort of weakening in the dollar?
I think there's still some concern about where the Fed is going to end up, who's going to be the next Fed chair, where are interest rates going. Will this administration take its foot off the neck of Jay Powell in the short term? I think Scott Bessent has done a magnificent job of signaling to the industry and the people here this week that, in fact, they're not going to hassle the Fed going forward. But it remains to be seen. The president could wake up tomorrow and decide to go in a different direction.
How much fear is there that the Fed is going to be prompted to cut rates disproportionately in the near term and inflate whatever, I don't want to call it a bubble, but whatever bubble there might be, whether it's in AI or whether it's in some of these credit markets that certainly are showing some strains, at least in terms of the credit quality underpinning them?
Well, all the aspirants to be the next Fed chair have all indicated that they want to see looser monetary policy, and they've argued a variety of different reasons for it because of productivity, AI. I know them all. I think they're world class. Any of the individuals that have been cited by Secretary Bessent and the president, I think, would be fabulous Fed chairs. But talking about it and being in the seat's different. And I think whoever gets the job will be much more prudent than maybe they sound today.
Is that the belief in markets right now? Is that the reason why people aren't taking the whole idea of Fed independence that seriously? And it doesn't seem like it's actually bearing out in any kind of market action that demonstrates concern?
Yeah, the people who've been decided are world class. And I know them all. They're quite good. Now, if you have some dark horse that comes out of left field and we don't know them and it has a different view, I would be worried. I would sleep comfortably with any of these people decided as replacing Jay Powell.
So were there any risks that people flagged to you, or did everyone just seem really
It's
happy?
still trade. It's still a lot of technology, stable coins. Where's AI going? Quantum computing, the technology stack. But it really is about, given the uncertainty in the global economy, we still have to navigate through it. We want a new equilibrium. Probably not going to get that for years to come. Chaos is the state of nature. It's just how do we work our way through it?
You know, I think about some of these events as, I don't know, counterindicators sometimes. And I know that in April, the feeling was pretty dark and people were gathering and asking each other questions that nobody could answer. This time around, there is incredible optimism. And honestly, it's been shocking how much optimism there has been from everyone who I've talked to, that there's going to be calm that prevails with trade, that markets are going to keep chugging forward, that deals are going to just accelerate. Does that...
It makes me nervous. Yes,
yeah,
it does.
But that's what I'm wondering. I mean, hasn't that been your impression as well?
Indeed. And, you know, in March, we were pro-Europe. Everyone was hurting into Europe. That was the place to be. Now people are pessimistic about Europe, unfortunately. So, yes, I think maybe too much optimism. I think the concern is more about technology. Where is all the technology going? What does it mean for labor markets? What does it mean for tech spend? But I do think we've just gotten used to the animosity between Beijing and Washington. We've just gotten used to the chaos and uncertainty. Maybe that's what people get paid for in the C-suites. It's to really manage and lead through times of chaos.
It's an irony that a lot of people are coming here and talking about the loss of U.S. exceptionalism and the loss of U.S. dominance. They're all here.
They're all here.
So doesn't that make you feel like maybe that's not the case?
Well, I heard one European CEO tell me yesterday, the U.S. is open for business. And I think it puts pressure on others. We hear it from the UK. The Chancellor was out yesterday absolutely on fire selling the UK. The Europeans are they need to be more aggressive as well.
Tim Adams, thank you so much for being with us. That was Tim Adams of the IIF. John, as you can see, a lot of optimism down here in Washington, D.C. from world leaders amid even some of those credit cracks and concerns that we talk about every day.
Hey, Bramo, thank you. Appreciate it. You see that optimism in the market. Futures recovering. We're now down by just 0.3% on the S&P 500. The turn, if you're just joining us, off the back of some comments from the President of the United States just moments ago on trade and the relationship with China.
Yeah, he was asked about the 100% tariff threat and what that would mean, given the fact that we already have double-digit tariffs in place when it comes to China. And he signaled, of course, that's not sustainable, and that will not be the outcome when he sits down with Xi Jinping later this month.
Stocks recovering in the bond market. Yields were lower, just a little bit higher now. Up next on the programme, we'll catch up with Steve Paliuka of Bain Capital as more banks jump on the EA buyout. Plus, Danny's got your morning movers. Truist Financial rising following their latest earnings. Stocks recovering this morning. We're now down by about 0.3% on the S&P 500. Only a few hours ago, we were down about 1%. on the S&P. So this is a quick, fast turn on the S&P 500 and the Nasdaq too. You see this also in the bond market. Yields were down across the board, 2s out to 30s across the curve. 2s now higher by a single basis point, 343. 10s up as well by a basis point at 398. Yields at the front end was sub 340 only 2 hours ago. This is a major change off the back of some comments from the president about 10, 15, 20 minutes ago.
A question about the 100% tariff that is that sustainable? The president basically signaling it's not sustainable. But I don't get the sense that no tariff level is not going to be sustainable. This is a president that we know continuously wants to use tariffs. I don't think that we're going to go down to 0% when it comes to China, but I don't think we're going to go to north of 100% was basically what the president signaling and also confirming that this meeting will happen. So when you talk about the two biggest economies, one thing investors always say, at least they're talking, and they will be talking, and they're going to be meeting face to face.
Looking forward to that summit later on this month. Let's turn to the gold market. Gold was higher. Now it's negative. We were on a 6-day winning streak off the back of these headlines. Just turning slightly negative. We're down by 0.2% on gold this morning. Still heading towards a 9th consecutive weekly gain for the precious metal. The longest weekly winning streak going back to August of 2020. Gold this morning, 4,300. As we count you down to the opening bell about 2 hours away, let's get you some morning moves and cross over to Danny Berger for more. Hey, Danny.
Hey, John. Good morning. Even some of those jitters around regional banks, the comments from the president seemingly lifting those as well. I guess it's overall risk appetite starting to come back into the market. Just moments ago, these shares were both down more than 1%. Western Alliance now up 1.5%. Zion's up 0.7%. Of course, these are the two mid-sized regional banks who've come out and saying that they're taking write-offs tied to loans gone bad, allegations of fraud. It's the credit concern that's been rippling through markets. But again, after those comments from the president, those shares turning positive. We also had some earnings that's helping out the regional bank space too. Truist reporting earnings in the past hour, and the key for them is that their credit quality got better. Their losses tied to bad loans was less than expected. They beat on a whole host of metrics, so those shares up 1.1%. Of course, they fell 5% yesterday in the drama, so still not recovering from them. We also got Amex earnings about half an hour ago, really strong too, even though the share price reaction isn't huge. It was the Platinum card that had huge amounts of signups. The CEO saying it was the best refresh cycle that they've ever seen. Maybe that was anticipated. Maybe that's why you're not seeing a reaction. But the CEO saying that there are a lot of concerns about credit out there, but ours is pristine. John.
Danny, isn't that always the way? Danny, thank you very much. A turnaround for some of those banks this morning. On our radar, credit concerns weighing on stocks around the world. Regional banks tumbling after Zion's and Western Alliance said they were victims of fraud on loans to funds that invest in distressed commercial mortgages. Those names have turned around in the pre-market higher across the board. Elsewhere, the three candidates for New York City mayor facing off. On the debate stage last night, Andrew Cuomo, Zohran Mamdani and Curtis Sliwa trading personal attacks and discussing various issues, including President Trump and their stance on the Israel-Hamas war. And finally, US-China tensions showing signs of easing. President Trump telling US media high tariffs on China are not sustainable. President Trump adding he's still on track to meet with the Chinese leader later this month.
It comes after this threat. The president on Friday talking about potential 100% tariffs on China after the fact that China was talking about and continuously is making it more difficult for U.S. companies to access rare earths. Now, the president was asked, you would have a tariff rate north of 100%, considering what is already right now stipulated on Beijing. And he's saying, no, that is not sustainable. It doesn't mean we're going to zero, but that high tariff threat, he's bringing down some of that heat we saw.
How much is new about that line, not sustainable? I've heard that line a few times from the president since April.
Well, I don't think anything is really new, given the sense that what happened Friday, the market was down off this threat and hot rhetoric, the tit-for-tat rhetoric between Washington and Beijing. And what happened on Sunday, the president saying is all going to be fine. So he already signaled he was looking for that off-ramp, and it's not going to be as high as he had threatened just 48 hours ago.
There's a turnaround in the stock market. We're down now by just 0.3%. Let's turn to private equity. The consortium buying Electronic Arts is set to add more than a dozen banks to its underwriting group after JP Morgan put up $20 billion of debt to bankroll the leveraged buyout. The banks are in line to share roughly $500 million in fees for arranging the financing. Joining us now, a man who knows something about a leveraged buyout, Steve Pagliuca of Bain Capital. Steve, it's good to see you, sir.
Good to be here.
Good morning. Let's reflect on your time. The largest leveraged buyout ever before this one was HCA back in 2006, 2007.
Right in there, yeah.
You were right there in the middle of it. Describe that moment and how it compares to what we're seeing play out now.
Well, it's really interesting. I think that buyout was $5 billion equity and $27 billion debt. this buyout is much more equity, kind of 30 billion of equity and 20 billion of debt, maybe 35 billion of equity. So the markets have changed to that extent that you can't leverage as much, but the EBITDA is a little less. Very quality sponsors, and JP Morgan is a very quality bank. So they did the deal because of the great growth in gaming and media and entertainment, and I think it's a very solid company.
You did tremendously well out of HCA. Need to be very, very clear about that. But the timing of it is curious. It came right at the peak of credit, and this is now too. Is that anything to be concerned about?
I'm less concerned about credit right now in terms of the private credit markets because the private lenders actually are very good. The banks have been very good. JP Morgan, especially Bank of America, well-run, well-capitalized banks. And private credit is different than credit from banks because if it does go bad, you only write off the equity from people that put the equity in. It doesn't have a systemic multiplier effect. So I'm less concerned about private credit. What I'm more concerned about is the size of the national debt and how much interest we're spending on the national debt. It's really interesting. If you go back to when I got out of business school, there was a huge Sturm und Drang about the national debt passing 1 trillion. That's in 1982. So it took 250 years to have 1 trillion of national debt. In the last 40 years, we now have 37 trillion, which is more than the GDP. GDP is about 30 trillion. So that concerns me more in terms of the impact on the dollar. Interest from the government now is one of the highest expenditures. It's right up there with defense and healthcare. So that concerns me more than private credit.
So, Steve, I could probably find you people who were concerned back in the 80s too. And then in the 2000s, and as we went through 10 trillion, 20 trillion, and kept going higher, they were concerned all the way up.
Yeah, unfortunately,
why is this moment different?
Well, I think I don't know if it is different, but in situations like this, it's always okay till it isn't okay. So you get used to, you pass $1 trillion. Everett Dirksen had a board up that was counting it up at that time, and it passed $1 trillion. There was a huge outcry. Now it's 10 trillion, then 20 trillion, then 30 trillion. But at some point, you've got to have some long-term plan to pay that money back and get that deficit down because it's eating up huge amounts of the government budget. And as the interest rates roll over, a lot of that is still financed in the old, really low interest rates. They're going to have to refinance it at 5%, 4.5%, and then the number goes up again.
Well, when you see what's going on in Washington, I want to go back to your EA deal. It's not just the size and scope that got a ton of people's attention. There's concern in Washington given some of the players involved. Have you heard from politicians about that?
I don't think there's been a lot of pushback on that, and the deal I think will be controlled by Silver Lake, which is an American, fantastic private equity company.
But with the Saudi PIF being involved, some people think Jared Kushner was brought in just to get the Czech government seal of approval.
Again, I think Silver Lake's a fantastic firm, and they're leading the charge there, and so I think there's really going to be no concern because they'll be calling the shots on the deal.
Steve, we started this conversation by comparing this deal to HCA in 06, 07. Have the pools of capital changed in the last 20 years?
Yeah, absolutely. When I started out in the industry, there was only 3 or 4 firms doing this, I think, in general, and it was mostly USA. Now it's global. The fund sizes are up probably 20 times from when I started. And also you have sovereigns and big institutional players partnering with private equity. So the dry powder is huge.
Are there enough opportunities to go around?
I got asked that question in 1989, 1990.
I'm asking it again, 27 years later.
And I feel like a broken record. Private equity, I think, is here to stay. The model has really evolved, so it really is huge value added to kind of transform companies, make them better, globalize them, build new products, and in an environment where you don't have to worry about quarterly earnings. So the model is a very good model, and it's only expanded, it's only gotten bigger. And I think there'll be plenty of opportunities for these folks to invest money.
Well, let's talk about the opportunities now for you and how your sport franchises are going, starting with Atalanta. Steve walked into the room with some Atalanta sneakers with the sponsor New Balance on. The relationship between you and New Balance, can you just describe what that's like at the moment?
Fantastic. New Balance is kind of a fighting brand, growing, taking a lot of share. They really like the Atalanta story because we have the same values. We're kind of a fighting brand against the vaunted AC Milan team that you support. And so it was kind of a match made in heaven. The New Balance is very excited about it. We're excited about it. We've just named our stadium New Balance Arena. I think it's the first arena that New Balance has named. And we're very proud to be associated with New Balance. It's a family company. The Pags Group is a family company, and the Percassis in Italy are a family company. So the three families have come together and hopefully take Atalanta to the next level.
You've done a tremendous job with the team and the franchise. Can you just describe the opportunities now that still exist in the sports world at a time when some people are pushing back against valuations?
Well, no question, valuations are at record levels. Why is that? Is because sports is now the only thing left that aggregates huge audiences globally. And there's been a technology change where, when I lived in Holland in the 1970s, you would only get sports scores 3 days later from an International Herald Tribune. You couldn't watch anything. Now you can watch any team globally, so fans are counted in the billions instead of the tens of thousands, what they used to be 30 years ago. So I think sports still has upside because advertisers, want to reach the globe, and that's the way to do it.
As you look at the sports world, and it's pretty broad, where do you see the best opportunity right now? Because your name's been linked to a team in the WNBA. I know you wanted to bring a team up to Boston. Is that where you're looking still, or is it elsewhere?
We're looking at many opportunities. I think the WNBA is a great opportunity. Women's sports in general, women's soccer in the USA and globally is growing. The NFL is the marquee properties. I think they had record ratings and record advertising on the NFL. So again, I think sports as a category is really a growth asset. And as you have this battle between old media and new media, it's existential for them. And they're battling over these properties that get all the eyeballs in. So I think that bodes well for all the leagues.
John mentioned the WNBA Connecticut team. Do you think that there potentially could be a future for you in that team?
It's something clear. We've kind of stood down for now, and we're going to abide by whatever the NBA wants to do with the team. I think it's very exciting. The ratings are huge for WNBA, and I think it's great that all Americans are following that sport now, and it's going to really take off, and the NBA's done a great job with that.
You've done a great job, Steve. It's always good to catch up with you. What a career. It feels like you're having the best of times now.
I've been very fortunate. My grandfather came from Italy on a boat with one suitcase and worked in a shoe factory here in New York in the Bronx for $8 a week. So I would say America's a great place. Coming from that, and I've loved the homecoming, coming back to Italy with Atalanta. I get off the plane. And I love it because everyone looks like me there. Haven't lost my Italian heritage.
We've talked extensively about this in the past together offline, and I'm very proud of you and everything you've done. Steve, thank you, sir.
I really appreciate it.
Thank you. Steve Pagliuca of Bain Capital. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. US-China tensions showing signs of easing. President Donald Trump telling US media that high tariffs on China are not sustainable. The president adding that he thinks we'll be okay with China. Trump is preparing to meet with Chinese President Xi Jinping at the APEC summit later this month. Gold is heading for its biggest weekly gain in 5 years. The precious metal is surging alongside silver as concerns over product quality in the US send investors looking for safety. Gold's gain of more than $300 this week is the biggest on record in dollar terms. Automaker Stellantis is partnering with China's Pony AI to launch self-driving vans in Europe. They'll begin testing level 4 autonomous vans in Luxembourg in the coming months, a move that is Pony AI's first major team-up with a Western car giant. It lays the groundwork for future European passenger robo-taxi services. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, bracing for future shocks.
We consider that where we are today, we are in a good place, and we are well positioned to face future shocks. And future shocks there will be.
That conversation up next with the Dutch Central Bank Governor live in Washington. Bit of a turnaround going into the weekend. We were down by about 1% on the S&P, now softer by just a third of 1% on the S&P 500. On the Nasdaq 100, we're down by just 0.5. More constructive comments from the president regarding China, lifting sentiment just a little bit. Under surveillance this morning, if you're just joining us, welcome. Bracing for future shocks.
Bottom line, we are currently, at least in the euro area, at 2% inflation, which was our medium-term goal. We are at 2% interest rates. It's a surprising coincidence. But we consider that where we are today, we are in a good place and we are well positioned to face future shocks. And future shocks there will be. Both Kristalina and Talman said it. I completely agree with that. We will be facing shocks.
So here's the latest this morning. The ECB President Christine Lagarde showing confidence that risks to inflation and economic growth have become more balanced. Lagarde signaling the European Central Bank is unlikely to cut rates at this month's meeting. Lisa joins us now from Washington for more with a special guest. Hey, Lisa.
Hey, John, thanks so much. I am here with a member of the European Central Bank, Olaf Slijpen. He is the new head of the Netherlands Central Bank as of July 1st. And Governor Slijpen, thank you so much for being here.
Pleasure.
I want to start with that contrast, this incredible optimism that you're seeing in the U.S. economy, notwithstanding some of the recent credit cracks. And yet the Fed is going to cut rates several times. And in the Euro region, it seems like the ECB members that we've spoken to seem pretty okay with where things are at right now. But there isn't that much optimism around growth. Does there seem like a dissonance there?
Yeah, from a monetary policy point of view, we are in a good place. And you have been hearing that a lot, I think, these days. Because inflation rate is basically around our target, 2% in the medium term. We have more or less full employment at the moment in the euro area. But having said that, the potential growth in the euro area is actually relatively low compared to the United States. I think not a lot needs to be done in this context, but that's not for monetary policy. It's more for structural policy.
At the same time, the trade shocks that Christine Lagarde, that Madame Lagarde was talking about yesterday, have to do with both, yes, tariffs, but the tariffs have come in much less than people have expected, but also China flooding the European region with cheap goods that have suppressed inflation. I mean, how much is that a risk, the disinflationary risk, that you're taking increasingly seriously?
What we see is that the euro area economy, and I think that's also true for the global economy, has been much more resilient than we thought it would be, actually. Yes, if you look, go back to a year ago, the economy has worsened. But if you look to the spring, I think things look a little bit better than we thought. So, yes, the tariffs do have an impact. They have an impact on growth. They may have an impact on inflation, in particular, I would say, in the United States. But, yeah, so far, the economy is holding up pretty well. At the same time, there are a lot of risks out there, and there's a lot of uncertainty. So it's very important that we remain vigilant in this respect.
Christine Lagarde was talking about shocks and future shocks coming down the pike, and yet there is this feeling that the bar to cut rates is pretty high at the ECB. Is that the case for you? What would it take for you to think, okay, we need to accommodate? I'm worried once again about disinflation.
Yeah. As I already said, we're in a good place, but that doesn't mean that you, let's say, will always stay in this place. We have what we call the meeting-by-meeting approach. We are data dependent, and depending on new data coming in, new forecasts, we make our assessment regarding the inflation outlook. And that's when we decide on what to do with monetary policy. And that's the approach at the moment.
It must be nice to receive data. We're envious of your data collection and your data releases of late.
It's extremely important.
We haven't gotten some recently.
Yeah.
I am wondering what your response is. We've been talking about cracks in the credit market in the United States and this potential that there could be some froth developing, whether it's artificial intelligence related stocks and some of the valuations there, or whether it's just some of the credit conditions that have gotten pretty loose. I'm just wondering how much you're watching that from a financial stability point of view, how you see that potentially rebounding into the European Union.
Yeah, I think if you look at valuations at the moment, I think one can say that they're pretty stretched. And that also means that, let's say, certain accidents, incidents, jitters can lead to more volatility. And that's something that we are closely watching, also from a financial stability point of view. That's correct.
What would your response be if there was some sort of stress event? I mean, because right now the market's implying that there's going to be some sort of Fed response in the form of rate cuts. We've heard from Fed Chair Powell that potentially they're going to stop rolling off their balance sheet, stop quantitative tightening. I mean, how much is the ECB also considering some sort of measure to ease the liquidity strains that might be emerging down the line?
I mean, when we say we are in a good place, it also means that we are of the view that we have the instruments let's say, that can be employed whenever it's necessary. And that's also being part of being in a good place.
Do you welcome the increase in fiscal spending in the Euro region right now? We're hearing that from Germany. We're hearing that in other places as well, to try to, yes, bolster some of the defense side of things, but also just in general infrastructure and to adapt to some of the AI build-out.
I think it's important here to distinguish what kind of fiscal spending we are talking about. It is good that governments are boosting public investment, and I think indeed Germany is a very good example in this respect. At the same time, we also have to acknowledge that the overall debt to GDP ratio in the euro area is quite high. So there is limited room, so to speak, to let fiscal deficits and debts increase too much. But indeed, more focus on public investments, I think that's definitely a good thing.
Is it frustrating for you when you talk about the need for some sort of growth engine in the Euro region and cohesiveness? And I hear this a lot in the sense that you can't rely on the United States, but then everyone's here in the United States talking about all of these things and talking about the growth and the optimism here. I mean, I'm wondering how you square that disconnect.
Yeah, I mean, it's actually good to be here and to, let's say, observe that optimism. What would be the lessons for Europe? I think when you talk to investors, then they tell me, they tell us that Europe, it's interesting, but it's not really a single market. We have 27 countries, and despite the fact that there's European legislation, there's also a lot of national regulation, national rules, gold plating going on. So the scale of the market is basically too small compared to the United States. So what does it mean? It means that we really have to create a true single market. That's one thing. So that markets, investors also really see Europe as one single market. Create a true capital markets union and finish what we started, that's the banking union. I think those are, for me, the three most important priorities for European growth.
Governor Slijpen, thank you so much for being with us.
My
Wonderful
pleasure.
to see you. That was Governor Olaf Slijpen, John, of the Bank of Netherlands, Central Bank of Netherlands, after joining back in July.
Lisa, very cool. Thank you very much. Appreciate the update on the European Central Bank. It's interesting to hear the ECB talk about policy being in a good place. And I understand why they're saying that. They have a very narrow mandate. It's an inflation target. But can you imagine the chairman of the Federal Reserve saying we're in a good place when they're forecasting 1% GDP for 2026? That ain't a great place for the European economy, that's for sure.
No, absolutely not. Europe has a growth problem. We've known this. And the issue they also have right now is they're stuck between the United States with higher tariffs, and they're stuck between China, which is absolutely decimating their industrial base. And Europe needs to decide, how are they going to fight back, or they're just going to allow it, which is going to mean a lot more layoffs, which we've already been seeing coming out of big European companies, especially in Germany.
They've got some policy issues. Just a lot of them are outside the ECB and beyond their control. Up next on the programme, we'll catch up with the Deutsche Bank CEO, Christian Sewing, James Picariello of BNP Paribas, Steve Rasciuto of Mizuho, Mark Haefele of UBS. The third hour of Bloomberg Surveillance up next.
We've got this extraordinary stock market.
The U.S. capital market is the most liquid of the world.
This has been an earnings-driven market.
We've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
I don't think we're in a bubble. And if we are, it's so early stage.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. We're focused on two bank names, two regional banks that are at the epicenter of the price action of the last 24 hours. They're recovering this morning. Zion's up by close to 4%. Western Alliance up by close to 2%. A lot of pushback against the concerns of the last 24 hours, including from R.W. Baird and David George, saying that we're fighting the last crisis, that a $1 billion market cap decline over a $50 million loss seems a bit excessive. Those two names are being bought so far this morning, and the equity market's turning around as well. Equity futures across the board on the S&P, the Nasdaq, erasing losses. We're now down just 0.25% on the S&P 500. similar turnaround in the bond market. There was a risk-off bid. Yields were lower. Now they're higher by a single basis point on 10s, approaching 4% again, 398.77. And a lot of that in the last hour came from some comments from the President of the United States.
The President had an opportunity to continue with the rhetoric on China and amp it up, and he decided to once again dial it down as he looks forward to this meeting he has upcoming with Xi Jinping. He says it's not sustainable, the high tariff level. Now, it doesn't mean we're going to go back down to zero, but that 100% threat on top of what already the United States has in terms of the tariff wall in China, he says that is not sustainable. So the market now can look at the worst case scenario being avoided as we head into the end of the month.
Hey, hopefully the worst case scenario is avoided. That meeting's going to take place in Asia at the end of the month. At around the same time, we get a Federal Reserve meeting and a ton of tech earnings as well. Coming up this hour, great lineup for you. The Deutsche Bank CEO just moments away. Christian Saving as credit concerns grow over the last month. James Picariello of BNP Paribas as he's downgrading Tesla ahead of earnings. And Steve Raschuta of Mizuho as bond yields break through 4%. We begin this hour with stocks lower as doubts grow over the credit health of US regional banks. Lisa is standing by with a key guest. Hey, Lisa.
Hey, John. Thanks so much. I am here with Christian Saving, the CEO of Deutsche Bank. And before we get started, I want to say we booked this weeks ago. This was not necessarily booked to talk about the credit issues that are emerging and to stave off any concerns that might be percolating out. But I do want to start there. This idea that this morning we're all focused on what are we missing? Have things gotten too frothy? And have there been some issues of fraud or easy financing conditions? Do you see that anywhere in your book?
Good morning, Lisa. No, actually not. There is a lot of volatility in the market. We have seen that actually over the last weeks and months. Whenever something is supposed to be there, market is reacting. In our books, I can tell you, no, there is no deterioration. We're very confident with our credit portfolio. And that across the world, whether it's in Germany, whether it's in Europe, whether it's in the US, in the different asset classes, corporate bank, private bank. And in this regard, I think the market is reacting quite heavily. But I think you always have to see it over the long term. And so far, to be honest, I see no credit deterioration.
Long term, your shares are up more than 80% so far this year. So a couple percent here or there. It's sort of, okay, it's tough, but we can manage through it. I am just wondering, though, whether it's indicative of people's mood, that people are looking for a reason to sell because they're getting nervous about how good things are getting and how far valuations have gone. Do you see that with any executives and the confidence that you're hearing from them in terms of what they're seeking to do or how much they're planning to expand?
No, actually, confidence is quite good. There's obviously always the risk in case a recession would come. Then obviously confidence would go down. You would also see then a deterioration in the credit portfolio. But this is not a topic at all. Also, in the whole week here in Washington, we haven't discussed the topic of recession at all. People are seeing growth. They're seeing employment. We talk a lot about what is happening in Germany and in Europe and how we can actually grow competitiveness and the economic output. So therefore, I wouldn't say that people are concerned. Of course, the geopolitical uncertainties, still trade discussions, other issues are also dominating the discussions. But I wouldn't say that there is a concern of the executives. We are watching the market, but there is nothing out where I would say people are concerned of a deterioration.
Given the fact that there are so many uncertainties still outstanding, are you surprised by how much optimism you've been hearing?
Yes, because we have talked for the last 2 years, given all the instabilities and uncertainties, when is actually a potential downturn in the markets coming. But again, there is a lot of liquidity in the market. We have seen it, for instance, in the second quarter when there was a stimulus program in Germany, how much liquidity came to Europe. And you see that people really want to deploy their money. And therefore, I think you always have to see if there is a slight decrease in market prices, liquidity immediately comes in again. And therefore, I'm still optimistic, actually, that we are not talking about an overvaluation. We have some stretch valuations, no doubt, but I wouldn't say that the whole market is overvalued.
Let's talk about Germany. And European banks in general have been on a tear this year. And it's been driven by this idea that maybe there will be deregulation and maybe there will be actual fiscal spending to support the region. Are you seeing any actual tangible signs of deregulation that you think could unleash, whether it's bank mergers, whether it's just more dynamism in the European banking sector?
Well, at least we have discussions. Look, there are also some tangible items like the delay in the implementation of FRTB. We have also in certain national buffers, when it comes to capital buffers, we have seen some movements of the national regulators, but also of the ECB. I think we have a constructive discussion with the ECB. We are obviously talking about that we, as European banks, are demanding a level playing field. We see the developments here in the US, we see developments in the UK, and therefore I think there are constructive discussions with our regulators, so there is some movement. Nevertheless, I think it's not only about regulation. I think the most important is how can we ensure that Europe overall, but also Germany, is actually increasing the competitiveness and growth. And therefore, we need to do more on the structural reform side, which goes way beyond bank regulations. That is actually the topic which we need to push for, because at the end of the day, regulation is important. We need a level playing field, but the most important is the underlying growth, and therefore we need structural reforms in Europe.
Is that fiscal spending? Are you saying that you hope that they increase it more and that you're already seeing stimulative effects from that?
It's both. I personally think that the debt brake alignment and adjustments which we have seen in Germany was the right step to do, but only doing this is not the right thing. Just increasing debt is not the right thing. What you need to do is, in parallel, work on structural reforms that it makes sense for corporates, private individuals to invest. And that has all about to do with, tackling the problem of energy prices in Germany, reducing bureaucracy, making sure that we are doing bigger investments into infrastructure, that the approvals for new investments are not taking that long as it did before. All that needs to be done. So aligning or just growing by a stimulus program will not be sufficient. We need in parallel structural reforms. And there I can see that actually the German government is taking the first steps.
What about businesses? How much are businesses in Germany moving away from places like China in terms of sources of business? How much are you seeing those fissures just in the companies that you work with?
Well, it's a result already of the COVID. I think after COVID, people really thought far more about diversification. We can see that German corporates, European corporates are very active in diversifying their supply chains, their production chains, and are also trying to invest more globally and less concentrated. You can also see actually that business are confident actually to really reinvest in Germany. You may have heard about the initiative which is running in Germany, the Made for Germany initiative, where more than 100 corporates are actually committed to invest over 700 billion euros in Germany over the next 3 years. That shows actually that there is confidence in the business, and at the same time that corporates are really redistributing their supply chains.
Are you seeing any clients trying to shift away from dollar exposure right now?
Look, there was clearly a trend in Q2 about reallocation, but I wouldn't join the core of saying, well, that is the end of the US dollar as the reserve currency. The US dollar will be the reserve currency, but I think that a lot of investors actually are trying to reallocate, and in particular with what happened in the second quarter in Germany, but also in Europe, you could see a shift to Europe, and that's actually the momentum which we need to retain and where we need to build on.
And this move away from the dollar has been largely in derivatives markets. I mean, how much has that just been on fire this year in terms of hedging any exposure to the dollar, not necessarily getting out of dollar-denominated assets?
Well, I think it's both. It's not only in the derivative market. We really have seen real flows, and therefore it has been a trend in Q2. It is a little bit reversing in Q3, and therefore it is so important, in particular for Europe, that they really continue with structural reforms. If this is not going through, if we are not continuing with structural reforms, then obviously growth and therefore also the inflow in European assets will not further increase.
How does that affect just whether there will be reforms or not? How does that affect where you want your footprint to be dominant, right? Do you want to be more in Germany? Do you want to be more in the United States? Do you want to expand more in one place or another based on your faith, hope, et cetera, that there will be reform in Europe versus what actually is happening elsewhere?
Look, Lisa, for me, it is that from a bank's point of view, the most important is to be diversified. And we as Deutsche Bank have taken a clear decision to be a global bank and to make sure that we are not too concentrated in any one of the regions. Of course, when you have your home market in Germany with 40% of the revenues, you have a great interest that this country is growing, that you have the right structural reforms, that fiscal stimulus is kicking in. But at the same time, despite all the talks about the end of globalization, globalization will not end. Globalization will be different going forward. But that needs actually global banks with local know-how. And that is actually where we are focusing in from a Deutsche Bank point of view. Strong home market, but being an international player. Because what we see from our clients, they would like to have a bank with an international exposure, with an international expertise, and that with a global network. And that's exactly what we want to be. So a diversified and a global setup is, I think, the key to success.
Are you interested in any acquisitions, or is this going to be a very organic process going forward?
It's a very organic process. Look, I'm very happy with the development which we have taken. You were just talking about our share price. I think overall the bank has done very well over the last 3-4 years. The turnaround has been completed. And now it's really bringing the bank from a 10% ROTE to the next stage. All levers for that are levers which are, so to say, within our own hands. It's about a better capital management. It's about focused growth. It's further about investing into technology to get further efficiencies out. All that is in our hands. And as long as I have the chance to further increase my return on equity with, so to say, homework, that is always the preferred option.
So not interested in any local banks that are nearby that you might bring under your hood?
Look, as I said again, if you can focus on yourself, if you can improve your return on equity by applying this homework, honestly, it's always the first option.
There's also a big question here about artificial intelligence and how much it's going to alter the size of the staff, the way of doing business going forward. Have you seen any material changes or advantages from using and adopting artificial intelligence of late that have really materially improved profitability or decreased staff?
Well, we have many use cases, and you can apply that across the bank. And the interesting part is it actually applies to revenues, i.e. customer satisfaction, interaction with clients. It applies to efficiency and cost management. And also it applies to something which is very important for banks, control and regulatory compliance. And in each of these three areas, we have seen great use cases. If you think about also our research department, they started actually applying AI. If you think about the precision of research reports with the help of AI, got far better. Of course, that has an impact in terms of the speed and turnaround of research reports. Same actually in other areas when you think about operations, the way we can apply AI. Now, the real important thing is now that we have a structural approach to all these use cases and that we have a clear priority. Where do we prioritize it first? Because you can imagine that everybody in this bank wants to apply now AI. We need to have a clear priority of investments, but I think it will be a game changer going forward, and it will be one of the key levers how to increase profitability of banks.
Christian Sewing, thank you so much for being with us this
Thank
morning.
you.
Christian Sewing there of Deutsche Bank, the CEO here in New York. And John, it really is a tale for the Europeans of looking to what levers can be pulled going forward, given some of the concerns and challenges facing the region.
Lisa, thank you. Great work down in Washington, D.C. Lisa there in the nation's capital. Let's get you an update on news worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The White House is poised to deliver a major win for automakers, easing tariffs after months of lobbying by Ford and GM. The Commerce Department is expected to announce a 5-year extension of an arrangement that allows car makers to reduce duties on imported parts, a key offset to Trump's record-level auto tariffs. Meta is set to seal an almost $30 billion financing package for its data center in rural Louisiana. Sources telling Bloomberg that Blue Owl Capital will split ownership of the data center, with Meta retaining just 20% of it. The deal would mark the largest private capital deal on record. President Donald Trump's former National Security Advisor John Bolton has been indicted over allegedly mishandling classified documents. Bolton was charged with 18 counts by a federal grand jury in Maryland. He served for more than a year in Donald Trump's first administration, but became an outspoken critic of the president. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, the Morning Calls Plus. James Picariello of BNP Paribas as he's downgrading Tesla going into next week's earnings.
Regional banks are sort of seen as this separate little thing. Wouldn't surprise me if, like was the case in 2023, this leads maybe to a bout of some consolidation and maybe some acquisitions. Instead of trying to find where the cockroaches are, maybe provide some protection within portfolios by going up the quality spectrum.
That was Lisanne Saunders of Charles Schwab weighing in on signs of credit stress in the last week or so. In the equity market, we recover. We're down by just 0.1% on the S&P 500, with the open in about 1 hour and 11 minutes away. That's the price action. Let's get you some morning calls. First up, Baird upgrading Zions Bancorp to outperform, calling the pullback, quote, excessive. That stock is bouncing back by 4.4%. Next up, Goldman raising its price target on Schwab to 114, saying EPS growth is on track to continue through 27. And finally, Mizuho raising its price target on Microsoft to 640, calling it a favorite stock with solid upside. They're your morning calls. Let's turn to autos. The White House gearing up to ease tariffs on imported auto parts for 5 years. Bloomberg's Craig Trudell joins us now for more. Craig, welcome to the program. What are we hearing?
Yeah, Gabrielle Coppola, our colleague in Detroit, had the scoop last night on this. So this is a case where the industry has been concerned particularly about U.S. vehicles that are importing parts from outside of the U.S., wanting to get credit for the fact that these are made in America cars and trucks. And, there's been relief already put into place where, for 1 year there was going to be a certain amount of recognition for the fact that those vehicles are made in the U.S., but that was going to phase out after 2 years. This will be an extension to 5 years. So it gives I would say this is an acknowledgement of the realities of this industry, where even if and when you do announce plans to build an entirely new car plant in the U.S., that can take 3, 4, 5 years before you go from announcement to actually having cars coming off that line. And this is an industry that, if it's going to sort of answer the call that the Trump administration wants, it's going to take time.
It's going to take a long time, potentially. Craig, thank you, sir. Thanks for jumping on and breaking that down. Craig Trudell there of Bloomberg. Breaking down the moves in the pre-market. GM positive by 0.75%, going into some big earnings over the next week or so. Tesla reports on Wednesday. James Picariello of BNP Paribas downgrading his rating on Tesla to underperform with a 307 price target. He writes Tesla may be the victim of its own ambition, in our view, with its insatiable appetite for growth leaving the company with more on its plate than it's able to execute unsuccessfully. James joins us now for more. James, good to see you.
Yeah, you as well.
Just build that out a little bit more. What did you mean by that?
Well, the fact is Tesla has a $1.4 trillion market cap. And how we've assessed it after valuing the auto business and FSD, full self-driving, and the energy storage business, 75% of the implied valuation rests in robotaxis and Optimus humanoid robots, right? So what we've done is try to put a real picture to what robotaxis and Optimus look like, even out to 2040, right? We've gone that far. And what we've assessed is when you compare Tesla's valuation to the Mag 7, right, to the Mag 6, right, if we exclude Tesla.
Sure.
The future 2035 looking profitability, it's towards the low end. It basically looks like a smaller Amazon, which is also in the Mag 7. And so then the question is, if that's what our version of the future looks like for these AI-led businesses, what's the right implied valuation?
What do you think it is?
I mean, I would generously apply the Mag 7 average forward EV to EBITDA multiple to Tesla's business. But how we've done that, because you can't just look at 2026, right? You have NVIDIA as the highest valued company of the Mag 7, excluding Tesla, at around 35 times, and you have Tesla sitting at 85. What we've done is we've taken that 2035 picture of Tesla, discounted it back to 2026, and then suddenly Tesla's valuation makes a lot more sense, where it's trading at around 18 times EV/EBITDA on our price target. And I think that's probably the appropriate valuation, and that's what informed our price target.
So let's take the robotaxi business. How proven is that concept right now? And how quickly do they need to show some real results?
So here's some context for how constructive we are for Tesla's robotaxi business, which still informs our underperform rating. The industry leader right now in robotaxis is Waymo. They've got about 1,500 active robotaxis on the roads today. And they've boldly said that they're going to expand to 3,500 by next year. We have Tesla in 2030 having 525,000 active robotaxis. Right? It just contextualizes how much credit the market is already giving Tesla for what is going to be potentially, right, an extremely successful story. But what does that successful story look like, and what's the right valuation? We've obviously made our determination.
We also have news at the White House, and it comes to the auto space, looking to ease some of the tariffs that are hitting these major players. That put them in line now with some of the Asian auto companies that actually were getting a lower tariff rate after Trump's trade deals?
Yeah, certainly. I mean, if we think about GM and Ford, right, GM's net tariff exposure is about $4.2 billion. For Ford, it's just under $2.5 billion. And yeah, I mean, when we think about GM and the South Korea trade deal that it should soon get finalized, you're looking at $1.1 billion, just over $1 billion of savings for GM. And Ford certainly will benefit from these tariffs relaxation, no question.
James, it's good to see you. Thanks for breaking down the latest call going into earnings next week with Tesla and a whole lot more. James Picariello there of BNP Paribas. The earnings story, tariffs. These guys, I think of GM earlier this week, just kind of stuck between a rock and a hard place. The tariff story, the EV story as well. Stellantis investing, what was it, $13 billion, that announcement earlier this week. They're getting squeezed from both sides.
Stellantis, I think this is their biggest investment in North America because they realize if the tariff walls stay up, which potentially they will, we're going to do more production in the United States. But yeah, a lot of these companies are stuck from a hard place because policy has swung so drastically between the Biden administration. Here, we're going to give some individual subsidies and help to go buy EVs, make those EVs, to the Trump administration saying those subsidies are not happening. And actually, the auto parts are going to be more expensive due to the tariff walls. It's hard right now to run an auto company.
If the policy is going to swing back in 4 years' time. Coming up on the programme, we'll catch up with Steve Rasciuto of Mizuho as bond yields break through 4%. That conversation up next. The opening about 60 minutes away. Lots of swings over the last week, but on course for a weekly gain on the S&P 500 after the close yesterday. This morning, steep losses, and we erased them. We take some of it back on the S&P 500. We're just about unchanged on the S&P 500. On the Nasdaq, we're down by just 0.25%. As we count you down to the cash open, let's get you up to speed on the movers out there this morning with your morning movers. Here's Danny. Hey, Danny.
Hey, John. Maybe exemplary of the calm that's overtaken markets are what's happening with the two banks that were the poster child for the next little critters to scrawl out from underneath the fridge. That is Zions and Western Alliance, the mid-sized banks that reported write-offs tied to loans made to a distressed commercial real estate developer that maybe was fraud. There are allegations of that. Maybe collateral disappeared. Either way, climbing 5% and 3.5% respectively. It coincides with the broader turnaround in sentiment in markets, but it also coincides with some of the regional bank earnings that we've been getting this morning. And we've had quite a few. We've had Truist, for example. We've also had Fifth Third Regions. You can see all those shares up that have reported because all of them also reported better than expected earnings. And key, their credit losses were less than expected. So no infestation here. Finally, one of the stocks that continues to lose steam this morning is Eli Lilly. Those shares down nearly 4% after Trump yesterday in that press conference with Merck saying that the obesity medication could be sold as little as $150 per month. As a reminder, Ozempic and Wegovy goes for about $1,000 a month. To be clear, the services for Medicaid and Medicare say that negotiations are still ongoing, but BMO notes that this just shows how tough and stringent those conversations are. So again, shares of Eli Lilly falling this morning, John.
Danny, thank you. Thanks for this morning. Look out for Danny and Matt Miller in about 30 minutes' time to run you through the opening bell. Better tone to the tape this morning off the back of comments from the President of the United States, a more constructive tone around the issues of China. And just seeing a report right now, Anne-Marie, that the Treasury Secretary will be speaking to his Chinese counterpart later on today.
So obviously they're going to be talking about trade and potentially what Xi Jinping and President Trump could agree upon in the next few weeks. Critical for the Treasury Secretary is going to be really trying to figure out if China can walk back their threats and what they potentially plan on doing in terms of choking off really the whole world when it comes to rare earths. Not just the fact that they own all these rare earths, they process them, they refine them, and then they sell them. And if we don't have access to that, that can affect everything from your cell phone to a tomahawk.
The very same week those two leaders sit down together, it's the very same week we get a Federal Reserve decision. The central bank going into the blackout period after the close today, but not after a week's worth of Fed speak. Bloomberg's Mike McKee joins us now for more. Mike, we get a ton of Fed speak going into the weekend. We've had a ton over the last week.
Yeah. We have indeed, and I'm sure everybody is glad that at midnight tonight we start the Fed blackout period. They can't talk to us for 10 days until we get to that Fed meeting on the 29th. We have had 17 Fed speeches, appearances, questions, interviews this week, and one more to go. Alberto Musalem sits down with me later this morning. There have been 10 different Fed speakers, and you can see the impact that they've had. You wouldn't really make a lot of money in Las Vegas on the change in those odds from 98% to 103%, and December 97 to 110. Well, you know, it's about where you think they are. And really, nobody has moved. We did this chart on Monday, and nobody has changed their position in terms of whether they're hawkish, dovish, or somewhere in the middle. The middle is the one where most people are, the largest number. So it looks like we are on track for an October cut. And as Chris Waller was telling you yesterday, then we pause for a second and see where we are if and when we get some more economic data before we start deciding on December. Markets have already decided, but the Fed is trying to make it clear that they haven't yet. One thing we did learn this week, Jay Powell came out on Tuesday and said that we are getting close to the end of QT, and the markets are starting to push in that direction. The Fed's standing repo facility has been taken up by the most amount since 2021 rather, in terms of banks accessing the facilities over the last 2 days. They are starting to show signs that there are some liquidity strains in the market. And we could see the Fed, even in October, perhaps, announcing an end to QT, or at least a timetable for that.
Mike, this was great. Looking forward to closing out the Fed speak with you, sir, and the St. Louis Fed president later on today at noon Eastern time. Don't miss that. Alberto Musalem, the St. Louis Fed president, sitting down with Bloomberg's Mike McKee down in Washington, D.C. Let's stick with the Federal Reserve. Governor Christopher Waller weighing in on the bond market.
If you think about cutting rates, which we're doing and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages.
Certainly after that conversation, we continue to drift below 4%. The 10-year below 4% at 3.99. Steve Asciuto of Mizuho writing the following. This is the minimum level of rates you would expect if the Fed were credible in its inflation target. At 4%, the yield on the 10-year is fully priced for an economy with little to no inflation risk. Steve joins us now for more. Steve, good morning.
Good morning.
Do you think we should be priced for an economy with little to no inflation risk?
No, I don't. I think there is more inflation risk in the system than the markets are currently pricing in. But I think the markets are pricing in the degree of excess liquidity that's still there. Even though we're seeing some chinks in the armor in terms of the quantitative approach here and what's happening in terms of some of the reverse repo areas, there's still an enormous amount of liquidity. And you see the way the market traded this week, especially earlier in the week in the credit story when we were worried about banks initially. And then we saw the Goldman issue come out, and the market was substantially oversubscribed for that issue while we're worried about banks. And so I think there's still an enormous amount of liquidity, and I think that's holding down the long end of the curve. Plus, there's the global deflation story that's holding down the long end of the curve as well.
When you say inflation risk, do you mean tariffs, or are you seeing inflation in other parts?
Well, I mean, we've got a Federal Reserve that wants to maintain full employment, and we have an economy where we are seeing inflation without much tariff running at well above its target, running closer to 3%. So you would sit there and say, okay, then there is inflation risk in there that's not being priced in. Now, you could say the 10-year is expecting, on average, the Fed to be credible over a 10-year period of time. True. However, we have been above 2% for 4+ years. So there starts to be a window there where this is a fully priced market. And I think that's part of the reason why, we had this rally yesterday afternoon, and then we've pulled back towards that 4% level, because it is a critical psychological level. And it's also a critical mathematical level because it's a 2% inflation rate.
Why is it critical psychological level?
Because it's an environment in which, when you look at most people who've been in the marketplace, if you break through 4%, you're usually looking at a substantial move below that, because something has gone wrong in the system. And that's why you had so much of a response to yesterday's announcements by Zion and so forth, in terms of the way the market's knee-jerk response took place on that. And now we're starting to see the pullback as we begin to realize it's more idiosyncratic than it is systemic.
And we've bounced back big time. The broader equity market has too. We'll be tracking that. I want to stay on course for the Federal Reserve and stay on track with you. This Fed and the recent decisions, and the next one too, is anchored to a massive step down in payrolls. What do you think they should be anchoring these decisions to?
I think they should be setting it up as an insurance policy standpoint. And I think they should be setting it up in an environment in which they want to make sure that they are achieving still full employment. That's what they say their target is. And I think if you wind up getting an unemployment rate movement that goes against their need to cut interest rates, then I think they should pause.
So this is a risk management decision.
Correct.
That's kind of what they're doing, isn't it? How much daylight is there between you and what they're doing right now?
There's not a lot. I mean, after the payroll employment numbers came out in August, I was on this call and we talked about the fact that they might as well just do 3, September, October, and December. And it looks as if that's what we're going to get out of it. And that will pull us back into, from my calculations, a marginally stimulative monetary policy standpoint. For the market, they still have to get to 3% to be neutral. For me, 4% is neutral. So if we get to that level of 3 3/4 or so on the 10-year note, then we're into a stimulative territory.
If their bias is to the labor market,
yes,
what do they do without a labor market report?
Well, I mean, as the chairman indicated the other day, they have the ADP numbers. They could look at some of the weekly claims numbers. They can look at some of the continuing claims numbers. They can do some work and adding those things up and making those kind of assessments. And I think you basically have to take into consideration that there's a lot of uncertainty built into this situation. If you look at the wall of worry, I mean, we've got a government shutdown. We've got the tariff situation. We've got the Chinese trade war negotiations, in terms of you want to call it that or not. We've got the Middle East hostilities. We've got the Ukrainian hostilities. We've got a government shutdown that doesn't look as if it's going away. We have the upcoming question as to whether or not the tariffs were legal or not in front of the Supreme Court.
Why not go on pause then for October and recalibrate for the end of the year?
I think you want to make sure if there is something wrong, you get it in October so that you make sure there's a good fourth quarter of the year.
Steve, I've got no idea what happens in May and beyond because we don't know what the leadership of the Federal Reserve looks like. But do you think markets might be underappreciating the potential for a pause from the new year up to May?
Oh, I think the market definitely is underestimating the potential not to get to 3%, yes.
Steve, it's good to see you. Thank you, sir. Steve Asciutto of Mizuho, more constructive on growth for next year and less constructive on rate cuts for the new year and beyond.
And what he's talking about is that there's still a lot of inflation risk in the system. To his point, the tariffs haven't hit yet. They really haven't hit a ton of consumers. Besides Levi saying they're passing it on, a lot of companies are actually just absorbing it. And we're going to start to see the effects the end of this year and then 2026.
Stop talking about trade for a while through the summer, and here we are in the last week, driven by the trade story again, going into these talks between the US and China. Equities were down 1%. A lot of talk in Europe and Asia about what happened in the US session yesterday. Credit stress coming to the fore in a couple of regional banks. And here we are with equity futures totally unchanged off the back of comments from the president a little bit earlier this morning on trade. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. US-China tensions, as you're saying, showing signs of easing. President Donald Trump telling US media that high tariffs on China are not sustainable. The president adding that he thinks we'll be okay with China. Trump is preparing to meet with Chinese President Xi at the APAC summit later this month. Apple is getting ready to launch a touchscreen version of its Mac computers. The new laptops will have displays with OLED technology and a full trackpad and keyboard. The touchscreen MacBook Pro is expected to be released in late 2026 or early 2027, with prices likely to be a few $100s more than current versions. In sports, the Toronto Blue Jays blew out the Mariners 8-2 behind a pair of home runs, leaving the American League Championship Series at 2 games apiece. In the National League, the Dodgers held off the Brewers 3-1 and now lead the series 3-0. And in the NFL, the Cincinnati Bengals edged out the Steelers 33-31 with a last-second field goal. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this week. This is a Blue Jays free zone, right? We don't talk about the Blue Jays?
Definitely. A Blue Jays free zone. I'm a little bit still.
You're still sore about that, really?
It's ridiculous. It's insane we lost those games. Absolutely smoked in Toronto, and it's embarrassing.
Okay, all right. No, we'll move on. Awkward. Up next, let's set you up for a day ahead. Plus, Mark Haefele of UBS Global Wealth Management joins us in just a moment from New York City. You're watching Bloomberg TV.
Fed's going to have to cut more than they expect. We could go all the way almost back to zero interest rate policy. We haven't even gotten to a recession yet or any real liquidity event. High yield spreads are still tight. The market's near all-time highs. This is not yet the real troubling part of the market. When we get there, I think the Fed's going to have to cut more than the markets think. I think it's going to be a global phenomenon, and I think you could need to go back there.
I try to stay open-minded because so many people have got so many things so wrong coming out of the pandemic. But that is quite a call from Matt Miskin of John Hancock. And I kind of understand his point. Even with GDP where it is, a lot of people are talking about a Fed taking rates down to 3. And I guess Matt's point is, what do you think is going to happen to interest rates if things get really bad? If this is the conversation with unemployment in the low 4s, what's the conversation with unemployment 1 percentage point higher? And then I start to think about, okay, maybe not 0, but you can get your head around the idea that you go back to the 1s or the 2s, and that's the point that Matt is making here, just getting you to think about what could happen in the future. What could happen in the future is equities could turn green because the equity market's turned around big time in the last 2 hours. We were down by 1% on the S&P 500, now down just 0.1%. On the Nasdaq 100, we're down by 1/3. We were down by more than 1%. You see it in the bond market too. 2-year, 10-year, 30-year bond yields were down across the board, and now they're higher across the board. 2s at 344. We were sub 340 when this program started. 10s at 399, and a lot of it is the President of the United States with a more constructive tone on China.
Yeah, he's like the Terminator this morning for the cockroaches everyone was concerned about when we walked in, Jonathan, earlier this morning.
Pest control.
Pest control, exactly, yeah. Because remember, everyone's saying there's a cockroach here, we're going to have all these credit concerns. Actually, the banks are turning around, and we might end the day higher when it comes to the banking sector and also the broader market. And the president is just basically turning down the dial when it comes to the rhetoric between himself and Xi Jinping and signaling the tariffs are not going to be as high already as he threatened as he goes into this meeting.
The swings we've seen in the market over the last week, since last Friday, have been unbelievable. We talked about Friday, the biggest one-day drop last Friday since April, biggest one-day rally since May on Monday, and then everything in between has just been a massive swing of anywhere between 1 percentage point to 2 percentage points every single session coming into Friday. As we count you down to the opening bell, here's the trading diary for today and into next week. Today, President Donald Trump meeting with the Ukrainian leader in Washington. Look out for that. Next week, some earnings for you. Netflix on Tuesday. Wednesday, we get Tesla. Thursday, Intel becomes a more and more interesting story. And on Friday, we will actually get some data. We'll get some data. CPI going into the weekend. Let's stick with the data. CPI could be the only government print the Fed gets ahead of the rate decision later on this month. Mark Hafley of UBS writing, with the Fed on track to continue its rate cutting cycle, we believe the case for quality fixed income as a source of portfolio resilience remains strong. Mark joins us now for more. Mark, welcome back, sir. Let's just talk about that income. Over the last week or so, that yield is just slipping away from us, Mark. What do you think is driving that story?
Well, I mean, it's a lot of factors. I think first, we do have some concerns out there about the labor market and other things. But, we've got a Fed that's going to cut. And then I do think this QT story is also important to this because, that was a huge factor perhaps in creating some of those term premiums. So that side of it seems to be coming together.
S&P 500 target for you and the team mid-year next year, 7,300, Mark. What needs to go right to get us from where we are to get us there?
Yeah, well, first, anybody who's in the equity market does have a call on AI, whether they like it or not. And we think that the CapEx can continue into next year. That's one thing. Second, again, don't fight the Fed. Third, the earnings are looking good. And fourth, the one big beautiful bill is going to start to add some stimulus as we get into next year. So that looks like a positive backdrop to us.
Even you're constructive on AI. Do you have any sort of concerns about the vendor financing that's happening within this space?
Well, 26 years ago, I sat down and was writing to clients about the dot-com bubble. And so writing this month was, brought back some memories. So, yes, I think that I remember, some of the circular financing of the dot-com very well. I think that it's still early stages. Obviously, somebody's concerned enough that it's getting disclosed, and it's definitely something to watch. We'll just have to see where it goes from here.
Mark, when it comes to what we had this morning, which was the bank sector under pressure, given the concerns of these bankruptcies and credit qualities, do you think that this could potentially be a longer-term problem within this space and that can affect and have contagion across the broader market?
On the banks, we're looking at the delinquency rates. They look like they're okay so far, and so we're still thinking this is kind of a one-off. And the globally significant banks, the large banks, are doing very well.
It's odd, Mark, that we finished the week talking about these issues, and I get them, they're important, we should track them, on a week when we've just had blowout numbers from the big banks on Wall Street, Mark. Do you see this market as a bit of a market of contradictions at the moment?
Well, I love talking to you on a Friday because you're looking back on the week with this sense of wonder, almost awe that like all the stuff that has happened. And so I agree with you. I mean, we've had a heck of a run in the market. We don't have a lot of data right now, economic data. And so every data point is important. But I think as some of the, as you highlighted, you have to look at everything that's going on, from what the president is saying to, what the Fed is saying to what foreign leaders are saying to, what you're hearing from companies, and put it all together in the right matrix.
The good news is, Mark, that in bad times, bonds are working. And I guess the good news for gold is that gold works when the market's down and gold works when the market's up. This is just a relentless rally, Mark. We're on a 9th straight week of gains, a run we haven't seen since 2020. This week alone, we're up by close to 8%. I think 7.5% is the number on my Bloomberg terminal right now. Mark, can we just finish that? The relationship between gold and risk. We were touching on this when we talked last time. How are you reading these moves in gold? What's it all about?
Well, I think that part of it is fears about kind of the dollar and this and the concerns about debt. But a large part of it is the weaponization of the dollar, after the Russian invasion of Ukraine, the use of sanctions, and central banks saying, hey, how else can we function that we're not necessarily beholden to the dollar system? And we continue to see that happening. Obviously, we've seen speculatory trades and retail come in on top of those things. But I think this central bank component is key to the story. And then, of course, underpinning this whole rally is the continued fiscal spending, deficit spending that goes on. And, it's don't fight the Fed, but also don't fight that tide of money that is stimulating economies around the world.
The Fed's an interesting component of this, Mark, and I'm pleased you mentioned the central bank diversification off the back of what happened with Russia, because that's been a source, a massive tailwind for this story. A non-yielding assets perform so well in an otherwise high interest rate environment. Mark, as we start to reduce interest rates of the Federal Reserve, is that just more fuel for the next leg of the trade? And what kind of numbers are you and the team considering?
Yeah, it normally would be, but I think that given this run, from here, we're a little cautious and thinking more of gold as a hedge against potential risks that pop up, rather than saying, hey, this is a great time to pile in for kind of speculative gains or trading gains.
Mark Haefele of UBS. Mark, thank you, sir. Appreciate the clarity on gold as well. Mark Haefele of UBS Global Wealth Management, breaking down a move on gold. We've had a long run. A really steep run. If you look at the chart of gold, it's like exponential over the last 3-4 months.
It's been relentless. And it's also interesting who's buying it. It's central banks, as we were just talking about, and that's been a story since Russia's invasion of Ukraine a few years ago, but also concerns about inflation, concerns about trade war, shoppers in Asia. There is a ton of demand around the world from different pockets of the financial system for this asset.
Since the middle of August, we've just sort of gone vertical on that chart. Great to catch up with Mark going into the weekend. Heading into Monday, here's the lineup for you. We'll catch up with Russ Kostrick of BlackRock, Amy Gower of Morgan Stanley, Sarah Hunt of Alpine Saxon Woods, Abby Yoder of JP Morgan Private Bank's going to join us as well. The next 2 weeks are going to be really, really interesting. So next Friday, a week today, we'll get some CPI data. Then the week after that really is the big one. We're going to spend the next week talking about it. A sit-down conversation potentially between the President of the United States, the Chinese leader, a Fed decision, and all those big tech companies. We've talked about the start of earnings season. Earnings season begins in 2 weeks' time. The major players on the planet, the big tech firms, reporting numbers.
And going into that meeting, as you would say of a Fed meeting, this Xi Jinping-Trump meeting is live.
Going to be quite a meeting going into month end. From New York City this morning, good morning. Thank you very much for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.